Good day, I'm Dr. Evan Gilbert. I'm a member of the Research Hive here at Momentum Investments Group, an adjunct professor in the School of Data Science and Computational Thinking at the University of Stellenbosch. It's my pleasure to introduce this webinar and the speakers. The title of today's webinar is Mind and Machines, the Future of Behavioural Finance. This is a topic that's very close to my research heart. I've always been interested in understanding how decisions can be made consistently better ever since I studied the capital investment decisions of manufacturing firms in South Africa in my own PhD 25 years ago. Machine learning and its use in finance is one of the current frontiers in the space and is one that we are actively exploring in the Research Hive at Momentum Investments Group and in our collaboration with the Department of Data Science and Computational Thinking at Stellenbosch. But before we go into the details of what's coming up, we'd like to thank both Jennifer Henry and the South African chapter of the CFA Society, and Nwala Walsh, who's representing the Global Association of Applied Behavioural Scientists, GAABS, for their support of this event. We'll be hearing shortly from them as they explain why they see an improved understanding of the use of machines in finance, and understanding better human decisions making in behavioural science is part of their respective organisations' missions. We are, of course, very grateful to the speakers as well. It takes time to prepare and present their work, and we are very appreciative of them for the work that they have made in this regard. From Momentum Investment Group's perspective, consistent, effective decision-making is fundamental to how we try and make investing personal. A client's investment outcome is the result of many decisions, some of which are taken by themselves and some which are made by their investment advisors and some by the investment managers managing their assets. As a result, behavioural finance insights and the potential role of machines in terms of delivering consistently better decisions are relevant all along this value chain and the resulting journeys for the clients. The choice of speakers and topics reflect this. Just some housekeeping before we start. We've applied for continuous professional development or CPD points. It's important to please watch the full session and add your ID numbers to the CPD section so that we can verify your attendance. You may also view this event on this platform at any time until the end of November and still receive your CPD points. Please also feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You'll also find more information about our speakers under the Speakers tab on the top menu bar, or if you scroll down, and you can download the PDF of the presentations. Please engage with our speakers and enjoy the event. First up is Jennifer Henry, head of the CFA Society. Jenny will be talking about the future of investment decision making as AI is used to bring in more behavioural science thinking.
Thank you, Evan, and hi to everyone. It's such a pleasure to present to you today, once again on this convergence of three fundamental topics, which are investments, behavioural finance, and artificial intelligence. In 2019, the CFA Institute produced a handbook called The AI Pioneers in Investment Management, where the Institute ascribed an artificial intelligence plus human intelligence model where AI could augment traditional investment analysis so that professionals in the investment industry could reach higher levels of decision making that leverages the collective intelligence of man and machines. This moves beyond just simply freeing up time for investment professionals, but rather incorporating AI and exploiting new technologies that ultimately lead to better serving our clients. We have always known that artificial intelligence and machine learning is only as good as the data which it needs to learn from, and that overfitting needs to be mitigated. Machine learning techniques incorporating traditional big data were seen to be more suited for systematic strategies, while unstructured and alternative data sources was typically used by active management to provide fund managers with one of the biggest opportunity sets yet, particularly since active fund managers have been criticized more recently for underperforming passive and indexation strategies. Natural language processing is a foundational AI that allows for machines to understand, interpret, and respond to human language. This tech analyzes human language and words into structured and understandable information for machines. Early on, these were hard-coded rules, but has evolved to use statistical and machine learning techniques to learn language patterns from enormous data sets. So natural language processing can perform sentiment analysis, language translation, and speech recognition. Large language models is next in the evolution and has been a huge step up from NLPs. Large language models like ChatGPT use deep learning to process and generate human language on an enormous scale. Large language models are trained from datasets, books, articles, and websites. So this extensive training allows them to generate coherent conversations with humans, which are actually quite contextual. Generative AI has taken large language models now onto the next level, allowing for the generation of new content, such as a poem, a story, or even new pieces of code. So with this quick overview, I can now describe how these types of artificial intelligence has been incorporated into finance and investments. An important benefit of incorporating AI into investment decision-making processes is that it speeds up and is more all-encompassing of what asset managers need to do on a daily basis, which is to incorporate new data and new information into their investment thinking. Analysts and portfolio managers assess investment opportunities by understanding companies, industries, and economies. Therefore, initial applications of NLP involved summarizing big alternative data such as customer reviews and social media content to gauge a public sentiment on companies and their products. Natural language processing also assists with reviewing government data, news, tweets, and public data sources, and can provide real-time insights which can influence investment decisions across asset classes. Analysts and portfolio managers see comprehensive data, including financial, competitor, and supplier and customer information. So alternative data sources like geolocation and footfall data offer more comprehensive insights compared to traditional financial analysis. And therefore, for investment professionals to take advantage of these AI technologies, they would have to develop T-shaped skills, or investment companies would have to develop T-shaped teams. This is referenced in the CFA Institute's 2019 publication on investment professionals of the future, changing roles, skills, and organizational cultures. T-shaped is a metaphor used to describe individuals who have a breadth of knowledge across experience and skill while being an expert in one field. Therefore, this individual goes beyond being a generalist. For investment professionals, what this means is that they would have to develop skills or take advantage of innovation and data science so that they can drive NLP and large language technologies that can help facilitate or augment their analysis. For investment professionals, having T-shaped skills and experience, particularly in behavioral finance and ESG, allows them to be better professionals for the future. Therefore, investment professionals cannot just be an expert on investments, whether it's identifying or analyzing an idea, blending them in a portfolio, or managing risks, but rather a T-shaped investment professional has the skills and attributes to integrate big data, machine learning, and other artificial intelligence technology to find more opportunities that become more visible with the use of AI, and to think about portfolio construction and risk management from a multitude of perspectives which AI can offer. Now turning to investment use cases. Before I move on, it's really important that these use cases are used with caution because they have to be appropriate for the investment strategy and the investment approach which a fund manager uses. But a simple starting point is the use of machine learning to do auto rebalancing, which may address some behavioral concerns, such as portfolio managers chasing winners. Artificial intelligence can help with framing information, highlighting key data, and reducing complexity, and helping analysts quickly grasp trends and anomalies without getting bogged down in the detail. Artificial intelligence can assist with showing the impact of decisions over the long term, and this type of scenario analysis can also be used in investment risk management. Structured decisions, processes, and checklists may also work for certain investment approaches, and these can be used to ensure that all relevant factors are considered and help prevent oversight due to cognitive biases. Another interesting use of AI is to do a pre-mortem analysis, and this can be done using a ChatGPT or a large language model, which encourages analysts to think about an investment going wrong and then helping them backtrack and to identify what are the potential risks and reasons for their failure. And another important element about managing money is being able to reflect on investment decisions to determine whether it was good investment thinking or just luck that really impacted on the performance. It may also be tempting for portfolio managers to believe that they were right, but the market got it wrong. And where AI can assist is provide regular and almost sometimes real-time feedback on these decisions and outcomes. And this types of reporting could typically take a lot of time and many man-hours to produce, but AI and machine learning can do that a lot more seamlessly and can also help identify behavioral bias. And analysts and portfolio managers then go on to have a conversation with their large language models to determine what could have been done to mitigate these behavioral biases. To the right, we have some famous, or should I rather say infamous, behavioral bias of analysts and portfolio managers. This topic is very important and a key part of the body of knowledge for the CFA program, particularly at level 3. A large part of this content or body of knowledge focuses on investors themselves and the biases that they have that could lead to suboptimal portfolios and returns. And a large component of it also focuses on the behavioral biases of investment professionals. The most infamous bias is overconfidence, which is overestimating one's own ability to predict market movements or pick winning stocks, leading to excessive trading and risk-taking. Machine learning can be used to develop models that analyze historical performance data to provide realistic assessments of an analyst or portfolio manager's predictive abilities, helping to recalibrate overconfident expectations. Natural language processing can be used to analyze market reports and expert opinions and other research, providing balanced insights or diverse viewpoints that counteract overconfident beliefs. The second example here is confirmation bias and anchoring, which is a behavior when seeking out information that confirms pre-existing beliefs and ignoring contradictory evidence, leading to skewed analysis and decisions or relying too heavily on the first piece of information encountered when making decisions, even if it is completely irrelevant. Again, using natural language processing to perform sentiment analysis on financial news and reports, highlighting both positive and negative information relevant to the decision can help mitigate this behavioral bias. Or generative AI can be used to create hypothetical scenarios that show the potential consequence of ignoring contradictory evidence. Herd behavior is where investors follow the action of a larger group, often leading to irrational market trends and bubbles. This can be mitigated by developing machine learning models that identify herd behavior patterns, either in trading data or other types of alerts. And it can then alert the analyst to potential market bubbles or corrections. Natural language processing can be used to highlight trends driven by herd behavior, or large language models can be used to generate independent analysis, which is at a contrast with the prevailing market sentiment. Again, all of this is encouraging analysts and portfolio managers to consider contrarian viewpoints. Our last example here is cognitive dissonance, which is the discomfort of holding conflicting ideas, leading to rationalizing or ignoring new information that contradicts existing beliefs, leading to either the other bias, such as confirmation bias or anchoring. Here, what machine learning models can do is continuously integrate new data and provide an unbiased analysis that can help reduce the tendency to ignore conflicting information. So from this slide, we show that by leveraging artificial intelligence technologies, investment analysts and portfolio managers can better recognize and mitigate their behavioral biases, leading to more rational and effective decision making. On the next slide, we are discussing how AI can help better ESG analysis. Analysts often overlook or insufficiently detail out environmental, social, and governance factors in their evaluations, even though these factors can significantly impact a company's long-term performance and risk profile. This deficiency can be due to a variety of reasons, including the lack of ESG data or standardized ways or processes for integrating ESG data into traditional financial analysis. Often, ESG assessments are framed more from a risk management perspective rather than being seen as value creation or as an opportunity. Analysts incorporating ESG information may also be more reactive rather than proactive. Here, machine learning could improve ESG assessments by analyzing diverse and large data sets, integrating ESG metrics with traditional financial data to provide a more holistic view of a company's performance and risks. AI could be used to create models that predict how ESG factors might influence the future financial performance, helping analysts to incorporate these into their valuations. Sentiment analysis about a company's ESG performance, providing real-time insights that might be missed by traditional analysis, can all help with the scoring of companies on their ESG performance. And again, this is a way in which analysts can augment the current ESG evaluations that they are doing. What is interesting is when looking at ESG and breaking it down into its individual components, environmental issues can come to the fore much better with machine learning, which can detect trends in environmental issues or regulatory issues and what that could mean for the potential companies that these analysts are covering. Also, social factors like labor practices, community relations, and supply chain ethics are often underanalyzed. And again, here, machine learning models can take in vast amounts of unstructured data and from there detect emerging social issues that could impact on a company's reputation and operational stability. Governance is a very important component in making an investment decision. And here, machine learning algorithms can evaluate a company's governance practices, board compositions, executive compensation, and compare them to other companies and industry standards and highlight any discrepancies or risks. There may be use cases that suggest that machine learning could also help detect governance failures in detecting anomalies, where algorithms analyze financial data and identify anomalies or patterns that are not easily detected by human analysts. Large language models could flag the discrepancies between earnings and cash flows early on, or machine learning models can uncover hidden relationships or patterns within the financial data. This could reveal suspicious activity such as unusual financial structuring. What we have shown today is that there are many examples of where artificial intelligence, machine learning, and other AI tech can be incorporated into investment decision making, and these can also incorporate the behavioral science component. All of this comes together in terms of leveraging the tools to enhance our human capabilities so that we can make more informed, rational, and effective investment decisions. By doing so, we can better serve our clients and contribute to a more sustainable investment landscape. Thank you for your time.
Thank you, Jenny. Next is Noala Walsh, a non-executive director, behavioral scientist, and adjunct professor. Noala will introduce the Global Association of Applied Behavioral Scientists, or GAABS for short.
everyone, I'm Nuala Walsh, one of the founding directors of the Global Association of Applied Behavioural Scientists, otherwise known as GAABS. Today we're just thrilled to partner with Momentum Investments and the CFA Society of South Africa to bring you this event. I hope you're looking forward to hearing from the impressive lineup of speakers. I think we're in for a treat. But first, let me share a little bit about GAABS. Established in 2020, GAABS is an independent organisation dedicated to representing applied behavioural scientists, primarily in the private sector. As many of you may know, applied behavioural science is rapidly growing, evidenced by the increased number of articles, organisations, media coverage and master's programmes. However, despite this various levels of interest and association, it remains an unregulated field, and this is a problem. I spent over 30 years in asset management and investment banking before becoming a behavioural scientist, and I saw firsthand just how much this matters. There's a real need to avoid the growing trend of people claiming to be experts in human behaviour. Why? Because the implications for organisations are just too great when human lives are at stake, just as much as corporate profits. Too often, we see unethical research practices or exaggerated claims and effects that dilute the perception of science. GAABS aims to address this by maintaining high standards in the industry. Although we're not a regulator like the FCA, SEC or FSCA, we do uphold rigorous membership criteria to promote member interests, offering a quality assurance stamp, if you like, for those brands seeking services from behavioural scientists. That means our members adhere to these high ethical standards, and that's central to what GAABS is all about. We're privileged to have an advisory board that features some of the leading figures in the field, including Robert Cialdini, Dilip Soman, Harvard's Jennifer Lerner, and until recently, the late Daniel Kahneman. GAABS is very much a global initiative, boasting 400 members over 45 different countries. All of these members have expertise, whether it's through postgraduate degrees in behavioural science or in associated discipline like psychology or decision science, or they've demonstrated significant contribution to the field, whether it's through teaching positions, published work, in a peer-reviewed journal, or authoring books. As with this event, in collaboration with Momentum and the Society of South Africa, we also strive to promote behavioural science through partnerships and collaboration. We also hold online and in-person events of our own, many of which are open to non-members and to which you are all most welcome. Because the field has seen such rapid growth in Europe and the US, we're also looking ahead, committed to fostering this broader engagement and expanding our reach. Another reason that today's partnership is especially meaningful. Thanks to you for tuning in and for your interest in incorporating behavioural science in your work. I do believe that this deeper understanding will not just improve your decision making, but the lives of other people in your world. And this is why I lecture, teach and write about this topic. Personally, I can be reached on LinkedIn or through the GAABS website. Equally, if you have any questions about GAABS or behavioural science in general, we'd love to hear from you. On behalf of the board, thank you very much for tuning in, and of course, enjoy the conference.
Thank you, Nuala. Ryan Murphy, the Global Head of Behavioural Insights at Morningstar, is next. He will talk about what clients look for when they hire a financial advisor. He highlights how the presence of these clients' blind spots when it comes to financial advice can create significant challenges for advisors, particularly when some of their most valuable contributions, such as behavioural coaching, are not actually understood or appreciated by their clients. He then shows how the use of large language models, or LLMs, can be very useful to help advisors understand what their clients are wanting from them. These tools can also help them to explain their service propositions in a way that better resonates with the client's expectations.
Thank you very much, Evan. I appreciate it. So let me jump right into the talk. I want to talk today about the evolving value of advice and what clients look for when they hire a financial advisor. So The basic question, the research question we were after is, why do clients hire a financial advisor in the first place? And when we look across existing commentary, it suggested that people seek out financial advisors to deal with particular issues like retirement planning or a windfall or maybe increased income, something along these lines. And it's not that these are wrong per se, but these foci are rather specific and they suggest a narrow job to be done mentality. And unfortunately, these are superficial answers that overlook different sources of value from financial advice. We're not the first to say this. So there's this fabulous study that comes from Merrill Lynch, which is a meta-analysis looking at lots of different other studies that have been conducted, looking at the kind of value creating activities that advisors do for their clients. So on the left there, you see all these different things that advisors might do. And for example, asset allocation, behavioral coaching, and so on. And then different studies in the industry have looked at the impact that this can have on clients' portfolios. And these are estimated BIPs per annum. Now, there's lots of different sources of value, but one thing that jumps out is the value of behavioral coaching, these kinds of soft skills. So on average, there's about 200 or so BIPs of value that's created from this. And this is very different than the narrow job to be done mentality. This isn't the only source for it. Vanguard has additional research along these lines, calling it advisor alpha, and different source of value that's created for clients based on good financial advice. And again, Vanguard's finding very similar things, that behavioral coaching creates a great deal of value for people. So this was one thing we noted in a piece of research we did a couple of years ago. We were looking at all the different things that people could have in financial advice and then asking them to start to rank order what they value. And one surprise we saw in our research was that these sorts of things of behavioral coaching or helps me stay in control of my emotions, which we know creates a lot of value for clients, are actually the sorts of things that are ranked very low for clients. So this is not the sort of thing that people are looking for, at least explicitly, when they are hiring a financial advisor. This is a bit of a problem. So I have a background in economics, and we have these models that say markets are populated by perfectly rational decision agents. This shouldn't happen, right? People should know what creates value, and this is what they should be willing to pay for. But there's a little bit of a mismatch between where value comes from and what clients might be looking for. So with this said, behavioral coaching is a tough sell. And paradoxically, some of the soft skills that are the foundation for some of the best sources of value in financial advice. But at the same time, these capabilities are not what people have top of mind, nor what they articulate when they're looking for professional financial services. And when I say not top of mind, for some of these things, it actually means bottom of the heap. So that was our research motivation for this particular study, this new research I want to show you. We know that some of the greatest sources of value from financial advice are not intuitively appealing to people. So then maybe if we better understood people's motivations and did so in their own words, and this is a point I'll get back to in a little bit more, then maybe we could better tailor value propositions to better reach investors, engage them, and compel them to make good decisions. So the simple question we asked people is, list some reasons why you hired your financial advisor. Now notice that this is an open-ended question. We're not just giving people a list. We're not asking them to rate things on a scale of 1 to 7 or something like that. This is a legitimate way to approach some research questions, but there's limitations to it as well. For this research, we wanted to try something different and use these open-ended questions, and like I was saying before, allow people to articulate in their own words what they're looking for. The research was administered on the Prolific platform, which is an online platform where people can go in, answer questions, and this is a way for us to gather data. And we engaged 623 households that are currently working with a financial advisor. So these are households that are investing, they're paying an advisor, they've hired one, and they continue to have an ongoing relationship with that advisor. One last thing is that this data comes from answering anonymously. And so I think that's a different kind of insight that potentially we could get from these data than if you, as an advisor, were to ask one of your clients why they are hiring, right? So in that situation, there's a lot of social pressure. They may not be as forthright as they could be. One of the advantages we have here is that we're not a party to this, we're outside of it. And also people are engaging with us anonymously. And that might give us a little bit more candid answers to be able to look at and examine. So these are the kind of data we see when we ask people to list reasons why they hired their financial advisor. People say things like, 2 minds are better than one. I just play around with my money, but he does it for a living. to help me to help keep my money safe now that I'm retired, to see if we're on track for retirement, and I wanted to be sure that I'm investing in good choices. One of my favorites from the set I didn't have here is, why did you hire your advisor? Well, the answer is because he's my dad, right? So there's lots of reasons people have for hiring a financial advisor, and those individual differences, a little bit of those stories start to come out in these answers. That's a really good thing. You start to get more detail, more nuance. You start to understand what people are motivated by, and they're doing so in their own words. But one of the drawbacks is that these are the data that we have to analyze. And it's not as though you can put these kinds of pile of words into an Excel sheet and be able to find an average or find some structure. It takes more sophistication to tease out meaning, to understand what's going on in there. So in order to deal with this, we use some new tools that have come online recently in the last 5 to 10 years. And this helps us meet the challenge of distilling these 623 households' responses into something that's more comprehensible. So we use something called an LLM, a large language model, with LDA, latent Dirichlet allocation, which is an advanced statistical technique to identify and find general themes and topic clusters that people mention when explaining their intentions. So for example, if one person says that they feel anxious, if another uses the word worried, another says scared, and so on, immediately you can see that these are all along the idea of anxiety that people might have for why they're hiring an advisor. That's useful, but you notice they're also different words. This approach we're using here would find that that's a cluster, that there's some sort of similarity in those answers and be able to identify that. And that's quite powerful when you look at data that's open-ended. It's not as though we take the data and just throw it at the algorithm and completely trust the results. We also cross-validated this. We used several human expert raters, and all of the raters, both the human and the artificial intelligence raters, converged on the same reported categorical structure. So what this allows us to do then is take a large pile of words, like I showed you before, and be able to turn that into a structure that looks something like this. So these are the categories or the reasons that we have at a high level that address the problem of, why did you hire a financial advisor? There's a little bit of structure immediately we noticed, and I've ordered them in such way now. Some of these tend to be more emotional for why people hire an advisor. Some of these are more financial or more transactional. So take a moment to look over these, if you will, and imagine you're trying to answer this question: why do people hire their financial advisors? And if I put you on the spot and had the benefit of calling on someone who is sitting in the first row, what would you guess? What would you say? Go ahead and take a minute. Maybe write down your answer on a piece of paper next to you, what you think is going to be the most common thing that comes out at the top, and they're lettered there at the side. So part of the reason I do this is twofold. Part of the reason to get you thinking, engage you a little bit. And the second reason is more selfish. Because sometimes when we show results from the behavioral sciences, people say, oh yeah, that makes sense, that was obvious. It's not so obvious before you get to see the results. And this is one of those studies where we looked at it quite a bit and thought about it, and it wasn't obvious to us what was going to come out on top. There were lots of different reasons we could imagine, and we were curious, actually quite curious, to see what the results entailed. Okay, so at this point, you should have at least made a bold conjecture. Let's find out how you did. If any of you guessed A or H, congratulations. These are the most common categories that people give as reasons. A has to do with client discomfort, handling financial issues, and issue H is specific financial needs or goals. These are the top 5. So these are the 2 I just showed you, discomfort and specific task or need. And then it's followed by behavioral coaching, recommendation, and the quality of the relationship. So we see about 32% of the reasons that people give entail some sort of discomfort or a specific task or need. About 17% of the time, we see people mentioning behavioral coaching. About 12% of the time, people cite a recommendation as to why they hired, and quality of the relationship about 10% of the time. Let me put in some of the examples. These are responses people had and give you some idea of how these are categorized. So discomfort, people are saying things like they feel more secure having a different view on their finances. Some people are pretty explicit that they don't like making financial decisions, or they don't feel they know enough to make the best decisions. So all of these highlight the discomfort that people feel and part of the reason they seek out professional services. Specific task and need, these are much more specific. For example, someone says they need help setting up an annuity or to better understand taxes or income management. Again, a very specific job to be done. And those are common. Like I said before, about 32% of the time, this is one of the major reasons that people are citing. Behavioral coaching comes in next. People say things like, I lack discipline to stay invested when the markets are erratic. People are looking for a sane voice to be an expert to bounce ideas off of. One thing that's worth noting is that although behavioral coaching is cited, part of the things people are looking for, that phrase never was used in the 10,000 words we gathered from these households. I'm not saying that it was rare. I'm telling you that it was never within the data set. So when we in the industry talk about behavioral coaching and its benefits, that's useful as we communicate with each other. But when we start to talk to end clients, investors, this is not the language they use to describe it. And I think that's notable. There are particular ways in which they talk about it and in which they're referencing it, and people are looking for this as a source of value. However, we have to be careful in how we highlight it, because if there's a mismatch between how we talk about it and how they talk about it, there could be some misperceptions. One thing that's notable is that the amount of, when you look across these different categories, that 4 out of the 5 are very emotional in nature. So you can see that here, discomfort, behavioral coaching tends to be emotional. Recommendations tend to be emotional as well. Almost always people are citing a close relationship, loved one, family, some sort of trust relationship that they have with someone, and that's part of the driver for why they choose to hire a particular advisor. All right, and that was, I think, one takeaway from the study is that many of the reasons that at the superficial level tend to be specific task or need. But when you look a little bit closer, a lot of the reasons are much more emotional as to why people are hiring a financial advisor. Okay, summary so far. Investors tend to overlook major sources of value from advisors. But when you start to dig into the data a little bit, you see that there's a richer picture that emerges. It's not so simple, the answers they give, but there's more complexity to it. So at this point, what are you going to do about it is a legitimate question. And that's one of the things I really like about our job in the behavioral sciences in industry setting, is that we have a chance to take the research to the next step and try and address this question. From an academic standpoint, this might be where we stop. We have the results, we publish them, we dust our hands and move on. But I think there's a legitimate question. The person who sits there in the front row and raises their hand and says, yeah, so what? So what do I do with this, that we try and address? So that's where we turned and we looked at the results and started to try and understand how could we better describe or explain major parts of the value proposition in ways that are more intuitively appealing to people. So what we did is when we looked across the results and the categories and the population of those different categories, we identified 3 general ways in which you as the advisor could start to address these with your clients. So first is acknowledging client discomfort, handling financial issues. So clients are pretty clear. They lack confidence in their own skills that are needed to reach their financial goals, or they lack the knowledge regarding financial and investing issues. People recognize this. There's an asymmetry of expertise, and that's part of the reason they're hiring an advisor, is to help compensate for that. They're not experts, and they want that expertise to weigh in to help them make better decisions and to feel more confident in doing so. Second, behavioral coaching. People tend to recognize that they need help, sometimes acting in ways that are beneficial for their own financial plans, including explaining what the financial plan is doing. And this is where they you're looking to cut through the jargon and understand the why of what they're investing in and how that helps them reach their long-term goals. Helping motivate them to stick to their plan over time, and also providing guidance as to what to do and what not to do during certain financial situations. And the third category has to do with specific financial needs. And this is a need for particular financial issues to be addressed, like retirement planning, handling new wealth, tax planning. The specifics, this is much more functional and more of the nuts and bolts. So let's imagine these 3 things here, these motivations that people have and ways to address them as a lens. And we start to try and then take apart a value proposition you might find and to see the degree to which it's meeting these 3 motivations. So let's imagine a particular value proposition, right? So let me read this to you here. At Murphy Wealth, I like it so far, good name. We are driven to provide clients with the best professional financial advice to meet their financial aspirations. With 20 years of professional service, we are uniquely qualified to address your financial needs, whether that be retirement planning, tax management, wealth accumulation, or more. What do you think of this? So when I've shown this before, the answer is kind of a shrug. Audience members, they're not too hostile, but they say things like, yeah, it's kind of bland, kind of humdrum. Yeah, could you imagine seeing something like this on a web page? Sure, as part of an email, absolutely. But it really doesn't land. It doesn't really resonate, probably. Okay, so back to the challenge. Based on these empirically driven motivational lens that we have here, this discomfort, behavioral coaching, specific financial needs, can we start to take apart a value proposition and redevelop it such that it more naturally resonates with what people are looking for? So something along these lines. So let's think the value proposition and start to rewrite it a little bit. So here we are back at Murphy Wealth. We are committed to helping you achieve your financial goals. Right. So this is one motif that comes up in our research repeatedly, whether or not we look for it or not. And if you were to go away from this talk and remember one word from it, it would be this idea of goals. It's worth remembering that being an investor is hard and somewhat unnatural, given how people are wired. Investing requires patience, delaying gratification by putting resources away and not spending them. And it also requires that people embrace irreducible uncertainty and are able to have risk and reward. Both of these things, patience and uncertainty, are things that we're not naturally well wired for. So why would anyone do this to themselves? Well, goals. This idea that people are investing to try and reach something bigger beyond where they are now, and that can be a powerful motivator as people think about investing. The more you can do this and articulate this, that's the goal of investing, that helps people understand what they need to do and helps them resonate a little bit more with the value proposition. So if you can work that into how you're explaining what you're providing as a service, that works rather well. So next line here, along the way, we make sure to provide clients with the education and guidance they need to stay on track with their financial plan. Notice we're describing here behavioral coaching, but we're not actually mentioning the word behavioral coaching. We talk about education and guidance. We talk about helping people stay on track. Notice that phrase by itself is already goal-centric. Here's where we are, here's where we're pointed, and there's a destination we're aiming for. So that goal centricity can even follow through into the language we use to try and talk to people about what the investing process is like. Throughout your financial journey, we will help you navigate financial decisions, whether that be related to retirement planning, tax management, wealth accumulation, or more, all with your financial goals in mind. So notice again how we've bookended this. Again, goal centricity is the core language here, but at the same time acknowledging that people feel uncomfortable, and that's part of what they're buying as a service, is ways to feel more confident and tamp down those feelings of uncertainty. Behavioral coaching is part of that they are hiring someone who will be there with them on the journey, answer questions, provide education and guidance. And their specific needs. That sometimes is the thing that people are looking to solve at the superficial level, but really what they're dealing with is more discomfort. Okay. So one thing you could do is start to tune your own value proposition to better fit what people are seeking. So think about the ways in which you can identify these top issues, how you're talking to your clients about discomfort, specific financial needs, and behavioral coaching. And think about ways in which you can work these topics into your messaging. Keep it simple, make it easy, and highlight the relevance. Keep it simple. One thing we found in a different line of research that's new and just coming out here is that jargon is a trust killer. We knew that jargon could be a little bit off-putting for people, but we didn't realize how specifically that undermines and cuts away at trust. And arguably, trust is one of the most valuable assets you have with your clients. So jargon not only creates a barrier of comprehension, but also can undermine that trust, which is really important. Think about ways in which you can de-jargon your value propositions and communications. Maybe even have additional people who are not part of the industry read over things to make sure that it's written in a language that they understand. Make it easy, help people know what they need to do today to get where they want to go, and highlight the relevance. Why are we doing this as investors? Well, to reach goals. That sort of relevance, I think, is helpful for people to understand why they're doing what they're doing. Much of this falls under the rubric of something called choice architecture, or this idea of a nudge, and that's what the little icon is there on the bottom. There's a fabulous book around this topic called Nudge by Thaler and Susting, talking about lots of different ways in which people can be helped to make better decisions. And it doesn't require that we have to teach people to be rational or educate them, explicitly a priori, but rather there's in the moment things that we can do to help people make better decisions, often by structuring the environment and talking to them in a language that resonates more naturally with how they're already thinking about things. So one of the takeaways I want to leave you with this talk is this particular worksheet. And so we have a white paper with the research I just presented here going through the details, but we wanted to make it really hands-on, something that you could use yourself in your own practice. And so this is a worksheet which you can download and try out. And I would challenge you to consider looking at the value proposition, maybe the language you use on your web page or your emails, and start to think of it through these three lenses we highlighted. Look at it maybe with fresh eyes, refresh it. So I'm sure it's pretty good at the moment, but there's always a chance to make it better. And so here's a chance to start to read through and to see where you're ticking off, dealing with people's discomfort, highlighting the value of behavioral coaching and what specific needs or things that they're after. And think of ways in which you can improve your value proposition and the language you use with folks. We've done this exercise with several advisors, going through and revisiting what they had written as their documentation and tested that. So we've done some recent work with advisors where they've used the previous version they had and an updated version. And we're seeing some evidence that this tends to drive engagement. It makes people more keen to take action, reduces the amount of uptime for people to be able to be onboarded as clients. So all of these things that we can do to try and smooth out the language of what people are seeking and make sure it resonates really helps, not only just from the standpoint of facilitating the relationship with clients, but also from a business standpoint of bringing them on board faster and more effectively. All right, high-level summary. So soft skills via hard science. So soft skills are exceedingly important. The more that we better understand investors, understand their motivations, understand how to engage them, this creates a lot of value. It creates value for advisors as they're creating a service, and it creates quite a bit of value for investors as they're trying to navigate the complexity of marketplaces and achieve their long-term goals. Soft skills, though, are not just sort of armchair philosophy or doing whatever sort of feels intuitive as an advisor. There's a lot of work that we can do, a lot of serious, hard science comes out of behavioral science and other fields to better understand how to engage with folks and how to effectively nudge them to make better choices. So notice the data sets here. We're coming from engaging with 600 or so households to understand what their motivations are. That I think is really powerful. So given the power of soft skills, being able to tune them and hone them based on these scientific insights, I think is something that our team is very much committed to and something that I think there's great promise in. We would argue that your value as an advisor is evolving, and we try and show how to explain major parts of your value proposition and do so in a way that's much more intuitively appealing to people. And we think that this reframing accentuates your value and drives investor engagement that adds to your practice. And all of this facilitates that kind of engagement and investors doing what they need to do to get where they want to go. And that promotes investor success, and that's part of all what we're trying to achieve. All right, this is what I wanted to cover with you today. Thank you very much. I look forward to the discussion and questions, and we can go from there.
Thank you, Ryan. Next, Derek Notman, founder and CEO of Coupler AI, will explain how technology can fix our relationship with money and serve the community. He likens the process of choosing an advisor to that of dating. For it to work, there needs to be an alignment of values. He shows how machine learning models can help with creating that link, leading to a more effective client acquisition strategy for advisors.
Evan, thank you very much for the introduction. I really appreciate it, and great to be here with all of you today. I'm really excited. We're going to talk about the future of financial advice and really about how we can use technology to fix our relationship with money while serving our communities. And as you can see here from the first screen of my presentation, this is me on a recent trip to Cape Town, South Africa. And what's so fun about this is that I met these folks because of technology. And I think at the end of the day, this just goes to show about the beautiful things that technology can do for us and how it actually can enhance human connection. So it's my belief that in the future, technology will enhance the human element and connection, not replace it. And the future is today. So what does the future of financial advice look like? Well, we're looking toward a client-driven future. Consumers are demanding a personalized financial guidance experience that aligns with their values, their hopes, their dreams, their goals, and so forth. They're also looking for strong client-advisor relationships that are built on more than just geolocation, but on shared values, shared commonalities, shared beliefs, and so forth. And the future, which is happening today, is that technology is actually helping bridge this gap faster and arguably deeper than we've ever been able to do it before. And how does this affect advisors especially? Well, advisors, financial professionals, the list goes on, really need to embrace this client-centric model because this is what they're looking for. This is the shift that is happening around the world, actually. And I refer to this, I actually published this with a couple other great thought leaders, but there's this thing we're calling the evolution of financial advice. And we've moved basically from what you could refer to as like a 1.0 up to a 3.0 financial advice. And what I love about this graphic here in this pyramid is that you can see here that most of us have started in the financial advice 1.0 area where we're getting things done. We're helping people solve their problems, purchase a product or service, alleviate some pain points, and so forth. But what's happened is that over time, due to some shift in advisor, I would say education and desires, but also really what is the consumers are looking for, is we moved over to more of what's called financial advice 2.0, which is looking a little bit more at, I don't know if we could say fully comprehensive planning, but definitely getting a lot closer to it. And we're digging into more of the emotional sides of the money and not just talking about what product to purchase to solve problem X, Y, or Z. And this has been a shift where I think a lot of advisors have moved into. And what's happening is that we're actually moving into financial advice 3.0 now, which is a much more comprehensive, deeper relationship that's focused all around what's really referred to as advice engagement, where we are using technology to help us get things done, and I'll get into that in a moment, that actually allows us to spend more time with our clients, to have deeper conversations, to better understand their hopes, dreams, and goals, and so forth. And ultimately, as we go through this pyramid or this progression, if you will, we have a better social impact. We are helping people get things done, but we're having a better understanding of why they want to get them done. And that means our solutions and the advice that we give also advance or get better. So one of the issues, though, if you will, is that we have this client-centric model. We have this shift from 1.0 to 3.0. But finding an advisor, finding a financial professional to help us, which is really important cornerstone to that whole pyramid I showed you, well, it's not that easy. Finding an advisor is actually a lot like dating. You know, where do we find the right one for us? Do we share similar interests, hobbies, and so forth? Is it going to be a long-term relationship or just a transaction? And so we know that money is personal. And we also know that birds of a feather flock together, and that ultimately trust and rapport are built when we connect with people on these deeper levels. And let's face it, because money is so personal, we're not going to just open up with anybody and share our financial skeletons. And so we have to figure out a better way to help people make that initial connection point, if you will. And this actually is feeding into a bit of what I refer to as a global problem. Now, as you can see here, we can really dig into this, but ultimately, it's my belief that our relationship with money is broken. And let's dig into this a little bit now. So consumers, why is it broken for consumers? Well, as we just talked about, consumers are looking for more engaging, deeper conversation, more meaningful relationship with an advisor around their money. They are attaching a lot more of their hopes, dreams, and goals to their money. And what I refer to is like they have a stronger meaning behind the money. And that meaning maybe has always been there, but we are much more self-aware now than we ever have been. But what the challenge is that there's this lack of personalization. There's this lack of control around the whole consumer experience when we're trying to actually get help with our money. And when that experience is broken, when the consumer doesn't feel like it's a trusting process, they lose control, it's not really personalized for them, well, then that by default creates a bad situation for financial professionals. You know, there's a lot of us around the world that are looking to serve clients. And I myself, I'm a certified financial planner. I've been an advisor for 19 years now. And I know just how hard it is to acquire a new client. I didn't start off with gray hair. It's really a challenging aspect of our jobs. And let's face it, most of us became advisors because we wanted to help people with their money. We didn't want to have to worry about prospecting and marketing and all of these things. And so we've got a very high cost of client acquisition. And when we have that, it puts a lot of strain on us as advisors to succeed. And in fact, there's some statistics out there that say about 9 out of 10 advisors actually fail within the first 3 years. So when we have a bad experience for consumers, a bad experience for advisors, the firms that we represent as advisors also have a lot of challenges, from advisor retention and hiring to product and services not staying on the books and so forth. And so when you put all this together, ultimately our relationship with money is broken. And this is where we have technology to actually help us. Well, what happens when we don't have a good relationship with money? Well, as you can see here, bad things can happen. When we don't have a good relationship with our money, things like poverty, higher rates of divorce, higher levels of stress, not being able to send the kids to school, buy a home, retire, change careers, the list goes on. There's so many things that I'm sure that you could think of now. It's a real challenge. And this, I believe, it's all because of the root of not really understanding our money and how it is a tool and connecting it to the things that are important to us in life. So I do believe there's a solution. Technology is definitely involved. That's why we're here talking about this today. And I want to share more about how we are actually trying to tackle this problem and what we think about it over at my company called Coupler. So our vision is that everyone in the world should have access to personalized financial guidance and advice, human guidance and advice. And it's our mission that Coupler is going to be the technology powering this access on a global scale to help people achieve financial harmony. As we talked about before, this is dovetailing in right into what the consumer, the client-centric experience is expecting and turning into. Now, what happens when we do have really good financial guidance, advice, and ultimately a better relationship with our money? Well, great things can happen. We have financial stability. We can sleep and not worry about money. We can have deeper and more meaningful relationships with our spouses, our kids, our communities, and so forth. Our levels of stress are actually reduced because we're not always thinking about money and what we're going to do. Also, more opportunities can come out of this when we make good financial decisions. We're able to actually capitalize on good decisions we've made and plan for great opportunities in the future. And this drives a lot of happiness, which ultimately is going to have great societal and community benefits about just uplifting everybody. And so how do you do this? Well, it's our belief that we need to focus on what I refer to as the human element to fix our relationship with money. Well, how? How exactly? Well, we know, as we've talked about already today, money is personal. And at the end of the day, when the cost of making a mistake with our money, with making a bad financial decision is really high, we may use technology initially to do some research and so forth, but ultimately, we're going to want to run this by a human advisor, somebody that can empathize with us, that understands us, that can have a deeper connection. And we know that when that happens, we're going to feel better about the decisions we've made because we've been educated, we've been able to discuss it out, figure out exactly what is the right path. And so how do we do that? Well, we believe that it's important to match clients, people looking for help with their money, with the right advisors for them based on a variety of human and financial dimensions, and then connect them at the right time and place for those right reasons. And when we do that, we can drive personalized outcomes that clients want. And so I'll show you an example here in a moment, but when we do this, when we focus on this human element, consumers now have a highly personalized experience that they are in control of and feel really good about. That helps financial professionals because now they have warm inbound leads that actually want to work with them, which means advisors have more time to spend on actually working with their clients versus trying to do all the marketing and prospecting and so forth that has to happen. And by default, when we fix these two aspects of our relationship with money, the firms that sell the products and services and so forth out there ultimately benefit. So here's an example of the solution. Some of you may recognize this company. This is Liberty in South Africa. Our solution, Coupler AI, it's a white label technology that actually matches warm consumer traffic in real time with the right advisors for them at a particular institution. And you can see here's a quick user journey of how this works, but it's all consumer driven. They get matched based upon shared commonalities, personality traits, preferences, and so forth, which is so much more meaningful. And we know this from countless data points and research done on human psychology, behavioral psychology, why people connect with each other, what's the basis for interpersonal trust and so forth. And so we wanted to create an experience and solution where AI and great technology can actually enhance the human connection. And that's what we're doing here, as you can see, while leveraging our partners' brands in the process. And what happens is that people now are in control. Consumers are in control of this experience and know that they are getting matched on more than just what their postal code is and how much money they have. There's actually a lot more meaning behind the money, which goes all the way back to this move towards financial advice 3.0 and deeper relationships, deeper conversations, and so forth with their advisors. So what makes Coupler a little bit different than the competition? I think it's important to understand this because this is part of our actual value add. We are a white label solution. This is really important from a brand and marketing aspect, of course, for our partners, but also from a psychological aspect. If I'm a consumer looking for help with my money and I arrive on company XYZ's website, I probably got there because I'm familiar with that brand one way or another, and there's a little bit of trust already. And the last thing we want to do is introduce some foreign name or brand that's unknown into this user journey where a consumer is already looking for reasons to go away. So we want to be an extension of our partners' brands, and in doing so, we create this safe space, if you will, where consumers feel a lot better about the entire experience. We're using smart matching technology. As I said before, we're not matching just on geolocation and how much money you make, but much deeper human elements. Again, shared commonalities, experiences, preferences, personality traits. Are we dog or cat people? Things of this nature. Because we know that when we are able to connect on these different human elements, that we can form rapport and ultimately trust much more quickly, which leads to deeper relationships. We are selling technology, not leads, which is also very interesting. This is really important because when you sell leads, you commoditize people. And commoditizing people has never worked out in the history of this planet. So we wanted to stay away from that. As I said, we're leveraging the power of AI and the network effect, where we're able to learn a lot about what consumer preferences and advisor preferences are, what they're looking for, why they're looking for it, how long they've been looking for it, and so forth. And then we can feed this information back in to make our whole entire matching experience that much better. Here in the States, if you're listening, we don't have to register with the SEC because of our model, and we're able to do this at a much lower cost than all of the other quote unquote solutions that are out there. So what is the opportunity? I think here, if we're talking about the future of financial advice and how technology can actually impact it and make it better, what I love, and I didn't quote this term, one of my friends, Adam Holt, did, but at the end of the day, we can use AI, artificial intelligence, to enhance advisor intelligence, AI. And this is really, really cool. We wear a lot of hats as advisors. We have to do a lot of different things, as I'm sure you all know. And if we leverage technology correctly, we can actually speed up business processes. There's a lot of things that have to happen, a lot of back office things that have to happen, things that have to get done, whether it's running reports, scheduling, doing analysis on financial products or services and so forth, building portfolios, building financial plans and so forth. A lot of these things still need to get done. Even, or just the fun stuff like filing and, there's a long list of things we don't want to really have to do, but they have to get done. So we can use technology to try and automate and speed a lot of these things up. We can also use it to actually learn a lot more about customer preferences at scale. Ultimately, we serve the client, so we have to know as much about them as possible, and we can use AI to actually do that. We can also use it to increase client engagement. Instead of just sitting there like we have done many times, I've done this many times, and you have this long report that you've printed out and you were just sharing, and it's really more of a one-sided conversation. It's really important to use technology that gets the consumer to engage, where they're really actually excited to use the tool. And what happens when they engage? We have deeper conversations. And if we've already connected on these deeper levels and we have similar interests, we've already established rapport and some more trust. Now these conversations become so much more meaningful, and we're able as advisors to get to the root of what is driving a client, what are their hopes, dreams, and goals, which gives us the best information possible to be the best advisor to them possible. Ultimately helps us spend more time with our clients, and that's what we want to be doing. So what are the impacts? Well, ultimately, we're able to help people through technology learn and earn more from their customers. And I'll kind of wrap it up with this here, is that I think at the end of the day, what's really important and where I see the future of financial advice headed is that we have to continue putting the human at the center of the equation and leveraging technology to enhance that human connection instead of replace it. There's a lot of talk about, is AI going to take over, or is the human financial advisor gone? I don't think so. I think if anything, the value of human guidance and advice is only going to become more valuable and more important as we move forward into the future of this great industry. And this is where I think you really have to be aware of what's going on, is that we want to be able to meet our clients' needs and their personalization and customization requirements. We want to be able to do that. And our technology, for example, is just one of many that is doing this. We want to be able to also empower advisors to spend more time working with their clients instead of looking for new clients. I think this is really, really important. Technology can help us do this. Technology is also going to help us learn so much more about our customers, about our clients, about the advisors as well. This is equally important, ultimately to help drive innovation. If a large company that serves consumers and has a large community of advisors knows more about consumer preferences, personality, traits, things they're looking for in an advisor, but also knows more about the demographics of their advisor and so forth. Now they have really valuable information that can help drive marketing campaigns, product design, and so forth. A lot of really great things here. And in doing so, we're actually able to just diversify and broaden the distribution footprints in the process. Ultimately, this enhances the relationship for everybody, and we're using technology to do it. So at the end of the day, where do I see the future? The future, well, it's actually here today. And technology is not going anywhere. But I think what if I were brand new to this, what I would take away is let's leverage technology and let's embrace it and use it to have closer and deeper relationships with our customers, while also using it to automate and speed up all the things that still have to get done as financial professionals. And in doing so, we have this beautiful thing that happens where we have deeper relationships, more profitable relationships with our clients. We're more scalable, we're more efficient, and we're doing what we want to do as advisors and ultimately helping our communities get that much better. And again, we talked about all the good things that happen when people make great financial decisions. Technology is helping us do that by letting advisors talk to their clients that much more and have those deeper conversations. So with that, I just want to thank everybody. It's been a real pleasure to be with you all for this conference. Really exciting. I love what Momentum is doing for us and putting on for all of us on a global scale, really. If you'd like to learn a little bit more about me or the work that we're doing, or even just join our newsletter, feel free to shoot me an email, go to our website, or just scan the QR code right there, and you'll be able to jump right into our website. I want to thank you all again very much, and please reach out if you have any questions or would like to chat further. Sending positive vibes your way. Bye-bye.
Thank you, Derek. We'll now take a short comfort break where you may want to get some coffee and watch the videos on our investments in the solar project at Karashok, as well as our latest Pambile internship and bursary program. We hope you enjoy these videos.
Our mission statement is simple. It's about unlocking the green economy. And basically this is part and parcel of unlocking the green economy, basically looking at how renewable energy can play a core part into this whole green transition. Other people ask me about where does the name Mvelo comes from? Well, it comes from the Zulu word Mvelo. I remember growing up, my parents always saying, you have to be in tune with nature. You have to be, in tune with the environment. So that's where we take our name from, Mvelo. It's about actually connecting with nature and the environment to do this kind of things.
Welcome to Karashok, Ilanga 1 concentrated solar power project. Today we have traveled to an incredible location in the beautiful Northern Cape to see how Momentum Investments is building a greener, more efficient future for our country.
The Northern Cape, where we stand today, has got one of the best solar irradiation in the world. And this specific site is in an area called Karos. It's flat land, vast pieces of land. They're ideally suitable for this type of technology. This is what we call a thermal energy storage solution. It has inside it molten salts. So on the right-hand side, we store at 200 degrees Celsius, and on the other side is the hot tank at 400 degrees Celsius. So what do we do with it? It works like a battery because during the day, you're getting your solar field, producing the electricity from there. And part of the steam we put in here, this is your big battery. So there's this analogy that solar cannot run 24/7. The partners we work with, we've configured how we can do it. We can produce base load electricity. That is power around the clock. So this is our water treatment facility. The water comes from the Orange River. We pump it 11 kilometers. And then it comes here, it gets treated here, and then we got our dim water that actually then goes into the facility. It was about how you develop a project in such a way that you can improve the social fabric of the people living in all the areas that are actually surrounding Ilanga CSP1. At the heart of construction, there were 2,000 construction jobs here. The people living in the nearby communities built this with the international guys who brought in the technology. So part of the benefits of bringing something like this is creating the jobs of the future. And in addition to that, creating clean electricity, greener electricity, that is good for everybody's health because there's no pollutants. And at the same time, it's helping South Africa meet its climate change obligations around reducing its carbon dioxide emissions. I think, for me, this can be the mecca of renewables, creating new jobs, new industrialization for the better of everyone.
I am often in awe and humbled by the incredible country that we live in and by the wealth of beauty that we see around us, from the dramatic landscapes to the smiling faces on the people that live here. Taking this trip has once again impressed upon me the fact that we as corporate citizens have a duty to build a better world, to embrace projects like this and to help grow a sustainable tomorrow. Standing here in this fantastic space surrounded by such an amazing project, I'm once again reminded that we at Momentum Investments truly do live our mantra of doing well by doing good. Because with us, investing is truly personal.
In 2021, we launched our internship program. Out of hundreds of candidates, 2 were selected to join the Phambili program and work within our organization to grow, learn, and be part of our commitment for the future. 2 years later, both the candidates decided to join the Momentum Investments family.
My journey in the Phambili internship program has been a very transformative experience. The program equips me with a comprehensive skill set, including financial analysis, critical thinking, and effective communication.
I think now it's further like specializing now to channel in and grow and hopefully become portfolio managers.
When we developed the Phambili intern program towards the end of 2020, our hopes for the first year were really just to dip our toes into an intern program and to use it as a trial run during which to learn for follow-up programs in years to come. Our staff really embraced the program, and it was clear to see that more experienced staff members were eager to become involved and pass on skills and knowledge, as well as to mentor the next generation of stars. The most pleasing part of the first iteration of Phambili was that it resulted in Paulina and Pafana both finding full-time roles as analysts in the investment team. Given the fantastic results of the first Phambili program and the incredible growth that our 2 candidates showed, we expanded our program, and this year, 3 new candidates have joined the team. We are committed to building a better, brighter future for South Africa. We want to be part of the solution, and we know the best way to do this is by making a meaningful impact in the lives of all the people our brand touches, because with us, investing is personal. Now, the time has come to meet our newest Phambili interns.
And yeah, I just want to do my best to kind of achieve the goals that I've set for myself.
I'm originally from Alexandria. I would describe myself as someone that is very resilient and aggressive about achieving my goals.
I'm very, very passionate about financial markets. So the internship program is great because we get to rotate all across the business. So I'm very excited about that.
We've taken on board some of the learnings from the previous year to enhance the program. We also expanded Phambili to include a bursary program for the first time this year, and we're proud to support 25 deserving students from across the country in reaching their academic goals. The Phambili program is a great opportunity for us as a business to play our part in nurturing tomorrow's talent, while at the same time increasing diversity in our teams and building a strong bench for the future. Long may this continue.
Welcome back. It is important to realize that financial advisors and investment managers are people too. Although they may deny it strongly, they are also prone to blind spots and other biases, even when they work in teams. Thomas Oberlechner, founder of Behavioral Quant, will talk about how machine learning models can empower investment managers and advisors. He shows how these ML models can provide insights into their own behavior, offering the potential for improved decision-making and thus client outcomes.
Thank you very much, Evan, for your kind introduction and for having me. I look forward to showing you how the newest behavioral technology can support both asset managers and advisors. So when people learn that Behavior Quant is based in Vienna, they often ask about Sigmund Freud. And I will tell them one of Freud's favorite jokes. It's about a husband who cheerfully tells his wife, "Should one of us die, I could still move to Paris." So I want to show you how this joke gets to the very heart of investing, and we'll return to it soon. But before that, let me briefly talk about metaphors. In my research at Harvard, at MIT, I worked with dozens of Wall Street institutions, from Merrill Lynch to Goldman Sachs. And I realized that when these professionals talk about the markets, when they talk about how they make decisions, they use metaphors. And these metaphors show that they understand the markets very differently, what the market means to them and how they make decisions in this market. So, for example, for some professionals, the market unconsciously is a machine, and it shows in their language. For example, they would talk about the mechanics of trading, and currencies turn into the fuel for the engine of the market. So these quotes reflect what the market means to these professionals and how they make decisions. And here the market is a perfect and reliable system. It has fixed rules. It has built-in mechanisms. It has inputs and outputs that are predefined and that are predictable. And this market has no feelings. So it's best to be detached yourself and have no feelings when you interact with this market. Here you see something quite different. Here you see the market as a war. It is a minefield. It is a dog-eat-dog world where you go out to kill. Making decisions in the market as a war means there's a constant threat. People fight for their lives. It's about self-defense. It's about survival of the fittest. It's about being strong, and being fearless is crucial. And you can use any weapons because moral rules do not apply. Last example of such an unconscious metaphor, here's the market as a living being. In this market, factors emerge that make the market nervous. Or professionals talk about emotional involvement that gets much too deep and where you get married to a position. So remember, these are verbatim statements of top professionals. In the market as a living being, this means here's a living organism that follows its own rules. It thinks independently, it reacts emotionally, and to predict it, you need to read its mind and you need to use empathy. And you're in a relationship that can get highly emotional. So we see that professionals, without being aware of it, have very different unconscious notions of the market. And these images fuel how they decide. You don't find these metaphors, you don't find these images in textbooks about finance because they are personal and they're highly psychological. But these metaphors also help us answer the two questions that I always get when I work with financial institutions. First question is, how do my customers really think? How do they tick? And second, why is the performance of professionals in the very same asset class so different when everybody has access to exactly the same information? These questions, I think, point to a core problem of the entire financial industry. Systematic and measurable knowledge about the people making investment decisions is missing. It's missing about professionals and it's missing about clients. And that has costly consequences because it leads to customers who leave their advisors, customers who leave their banks. We know that 5 to 7% of customers leave their bank every year, year after year. It leads to underperformance. We know that over 30% of the returns of active fund managers depend on their behavioral traits. So with the wrong traits, they give away 1/3 of their returns. It also leads to poor manager selection. As many of you know, when allocators select fund managers, many of the risks involved are not visible. So managers who score high in the dark triad of personality underperform others by 33%. So these behavioral risks of professionals can lead to huge losses. Remember Bernie Madoff? But systematic insight is also missing about customers, of advisors, and of banks, really about anybody who makes financial decisions. So fortunately, behavioral finance has started to provide us with insight about the psychology of investors. These insights have been driven largely by economists. And given that they are economists, these are insights about investors in general. For example, we know that investors generally suffer from various decision biases, such as overconfidence. Returning to Freud's joke, this joke has the greatest relevance for the investment world. It's an example of overconfidence. This husband is overconfident. He's sure that he and not his wife will survive and move to Paris, like so many professionals who overestimate their investment abilities and their own skills. And like Swedish car drivers, where 90% rated themselves as above average drivers, something that, of course, is impossible merely on statistical grounds. But we can learn about investors from people explaining their car accidents. Here are some verbatim statements from insurance firms. An invisible car came out of nowhere. It struck my car and vanished. Or a pedestrian hit me and went under my car. So we see there's a very important reason for overconfidence. People attribute their failures externally. They blame the environment, or they simply had bad luck. So when investors make random profits, they think it is because I'm a genius. So here's what we found in my own research with hundreds of Wall Street traders. 75% of these traders think they are more successful than their peers. Only 1 in 20 think they are less successful. So we have a ratio of above average to below average traders of an impressive 14-1. And here you see a king and a queen with their symbols of power and wealth, and they are dancing with death. It's a painting by 15th century master Notke. And Notke didn't know anything about today's investors, but he knew something about overconfidence. The empress says, I'm young, I'm the empress after all. I thought I had power. I never even guessed death, was coming, or that anybody at all could touch me. To which death replies, Empress, you have far overrated yourself. It seems to me my existence has slipped your mind. The time is ripe. So behavioral finance has identified psychological forces that generally influence investors. For example, overconfidence. But what about specific individuals? What about this client or that professional? How can we take the next step? And how can we predict individual investment behavior? This is where the new behavioral technologies come into play. Here's a video from our research with thousands of investors. And you see that each of these colored dots that you see is one individual investor. It's about how this investor processes information and how this investor makes investment decisions. And you see that each dot has a different position in the behavioral universe. And this means each investor is different from the others. And now let's take a close look at one of these dots. Let's take a look at one single investor. Already Freud said we cannot see the structure of a crystal on the outside. We have to open it to see its invisible structure. So let's examine this investor's structure. The structure is made up of his invisible psychological, his invisible behavioral aspects. Simply think about yourself. Think about how you are different from other investors. You have a different personality and you have very different preferences. You have a unique way of how you process financial information, how you turn information into investment decisions. You have unique traits that are specific to you that support good investment outcomes. And you have your own personal values and your own goals with your money. You're affected by decision biases, and you may have certain weaknesses, and these biases will affect your investment outcomes negatively. You have your own way of how you take risk and how you react to market volatility. So it's really the combination of all these aspects that determines how you make investment decisions. And these aspects are usually completely invisible. But if we can make them visible, then we have something that's highly predictive of your future behavior and your outcomes. So the question is, how can we bring to light this invisible structure? The answer, we need a highly systematic, we need a highly quantitative approach, we need behavioral science, and we need machine learning. So let me briefly tell you about behavior quant. It's the advanced technology that generates predictive behavioral profiles of investors. The technology is fully automated, which means that users can easily analyze any client, any investment professional, or even any investment team. They receive immediate results, predictions, and support for their decisions. How does the technology work? It's fully automated software. It's in the cloud. It's turnkey. You simply use your browser to log in, and it's easy to use. There's no need to know the latest research in behavioral finance. You simply use the system to invite any person, any team. The system will send them an email. They click a link in their email, and they're automatically guided through a series of questions and decision scenarios. So we worked with some of the leading universities, many of the leading psychometric centers to develop this survey. It's gamified, it's interactive. As soon as a person has finished the interaction, you see their detailed profile and you receive their predictions in an online dashboard. The system is hard to game because it doesn't take answers at face value. All these questions, all the questions in the system are only stimuli. And as you go through these questions, you react to stimuli in your own individual way. The system then compares your pattern of reactions with thousands of other patterns that we have in the database to determine your results in a fairly reliable and much more objective way than other systems can do. So what are the results you can get? Let me start with behavior quant for advisors. Imagine you're an advisor, and I know that many of you are. So here you are with your client. This may be a new prospect, or maybe it's somebody you've worked with for many years already. You will see this client's risk-taking values and the portfolio mix that matches this specific client. But the system also lets you tailor your relationship, tailor your communication to this specific client. You see the client's personal style, you see his investment goals, you see his expectations of you, you see any changes in the client's satisfaction, you see how the client makes decisions and how he reacts to volatility. As an advisor, you also see predictions about the client's future investment behavior. For example, here's a prospect who will be a very valuable client because the system predicts that he will be highly willing to invest, he will invest frequently, and his price sensitivity is low. So let's make sure we keep him. And these predictions are precise. For example, take customer churn, one of the predictions the system makes. We know that without these predictions, advisors often have no clue about who will leave them. And then at the end of the year, they receive a surprise letter. The client has left already, and yes, please transfer my money. So advisors, banks usually cannot predict such departures. It's more like tossing a coin. We saw that with hundreds of clients, the prediction accuracy with the behavioral data from behavior quant We improved it from 50% random to over 90%. Advisors also receive recommendations for tailoring the advisory relationship. So the system will translate the results into concrete, actionable recommendations. What does that mean for me as an advisor? For example, here with Charlie, you should quickly contact him when markets become volatile. Why? Because he's highly emotional in his decisions and he's vulnerable to stress. The technology also lets advisors or banks segment all their clients. So this way you can easily identify groups with similar needs and similar interests. So there's valuable business intelligence at your fingertips. For example, you can look up which of my clients have the highest churn risk, the risk of leaving you. So you can talk to them before they leave. Why should advisors care? Why should they use this kind of support? There's a recent study by Charles Schwab that compares advisory firms that use behavioral finance with those that don't, and finds that advisory firms that use behavioral finance gained 3 times more new assets from existing clients. The reason? A much better customer experience and a much higher customer satisfaction. There's a survey by the Investment and Wealth Institute where advisors report that with behavioral finance, they manage client expectations better, they manage short-term emotional decisions better, and they are better in keeping their clients invested during times of volatility. Let's move from advisors to asset managers. How can BQ support investment teams? Asset managers can systematically enhance their team's performance. They receive completely new data about the team and about its participants. For example, Behavior Quant identifies the team's unique competencies and the team's strengths. You can see in detail the team's weaknesses and biases. You can anticipate how the team takes risks in different market conditions. And you see how members interact to make decisions. And by the way, in high-performing investment teams, these decision styles are diverse, so members can process market information more fully, and they can react more quickly to changing markets. You can see the team's strengths, and you can see where each individual member stands. And very importantly, you can identify weak spots, you can identify hidden biases, and you get strategies for how to counteract these weaknesses. So team members, each individual team members receives their individual report. They see their personal results, they see how they benchmark against other professionals. The report identifies their unique strengths, their biases, and it provides them with improvement recommendations for their decision processes. These recommendations are based on your individual results. And why should asset managers consider debiasing their decisions in the way that I described? There are studies that show that investors leave behind 1 to 4% returns each year due to biases such as overconfidence. And professionals are equally affected by some of these biases. Our own research with leading financial institutions underscores this. We compared top professionals with their average counterparts, and we found that behavioral aspects explain a large part of performance differences. And finally, here's how BQ support allocators. If you're an asset allocator, the technology supports your evaluation and your selection of fund managers. You can compare individual professionals one-on-one, and you can compare entire teams with each other. The system lets you explore in detail how the teams compare, and the system recommends the team that's most likely to outperform. How can it do this? Because its predictions are not simply based on past results, which can be random. They are based on how the team makes decisions, how it translates information into investment decisions. Now, that is something that predicts future performance. And that brings allocators measurable benefits. For example, fund managers who score high on the so-called dark triad, lose 100 basis points in annual returns. For another example, the cost of bad hires among financial professionals estimates are 3 times their annual salary, so highly considerable. So let me summarize. These new behavioral technologies provide 3 main benefits. Advisors can easily establish tailored relationships with their clients. Asset managers can optimize their investment performance, and capital allocators can select the right fund managers. This medieval picture here nicely sums it up. You see a wanderer who peeks outside the visible world. It's like an investor who discovers the new universe of behavioral data. So we are thankful of the international recognition Behavior Quant and our behavioral solutions have received. And if any of this sounds interesting to you, I brought a special offer. This is for webinar participants. It's limited until end of September. If you go to the website of Behavior Quant, or behaviorquant.com, use BQ Momentum 2024 to receive a discount. You can use this code to analyze and to benchmark yourself, and you can use this code for your work with your clients. Here's the code again, BQ Momentum 2024. And this concludes our session. I'm Thomas Oberlechner. I would love to hear from you. Thanks very much for joining me.
Thank you, Thomas. Next, we have Paul Nixon, our own head of behavioral finance. Paul is a great colleague of mine, and together we have significantly advanced the case for the use of machine learning in the advice process at Momentum Investments Group. In this talk, Paul will tell us about his work in using psychology and machine learning to reduce the behavior tax. In other words, the loss of investment performance due to poorly timed investment switches. This lays the foundation for advice models that are hyper-personalized based on relevant insights.
Thank you, Evan. Hello, everyone. In a recent CNBC Future of Advice presentation in Miami Beach, tech forward and award-winning Canadian financial planner Jason Pereira reminds the audience, and I quote, "If you're a financial planner with a value proposition of picking stocks or mutual funds for a client, you're in for a tough decade ahead." In fact, fund picking was never really the value proposition for financial advisors in any event. Most clients just want to know if they're going to be okay, and if the pot of money they're growing will be enough to solve real human problems, like not being a burden on their family or friends in retirement, or being able to enjoy experiences like travel with loved ones. No one walks into your offices as a financial advisor and asks, will you beat the market or all-share index by 1%? And this is no different for wealthy clients. Jean Brunel, who is a family office advisor in the US, spending much of his career with JP Morgan, gives the story of advising a New York-listed company CEO. His approach centers on taking the necessary time to help his wealthy clients connect with their goals. Brunel paints a picture of this very powerful CEO figure being reduced to tears when asked the question, 5 years from now, what does failure look like to you? The client responds, if I ruin my children, or grandchildren rather, by giving them too much money too easily. How can we advise clients without a deeper understanding of what failure means to these people or in this client's life? Again, as we see in this example, many of these goals are not linked to beating the market or expressed in portfolio returns. As Brunel puts it, he doesn't talk risk and return with clients, he talks dreams and nightmares. Deeper investigation into Brunel's process reveals that he doesn't shy away from the technicalities of financial markets either, being a CFA charterholder himself, but only gets to this once he has a very clear picture of what is important to the human being he's dealing with. So what does the future hold? Advisors are already using AI tools like Podcastle to sample and clone their voices and generate podcasts for their clients in minutes to supplement financial education and market commentary, for example. Use generative AI like ChatGPT with Podcastle and you're generating content in the fly in a fraction of the time it used to take. If you want to go a step further, you can even create an avatar of yourself to deliver that message in person. The new Advisor's Toolkit, however, is simultaneously filling up with more EQ toolsets. As AI can manage tax efficiencies in a client's portfolio and discretionary fund managers, for example, chart the optimal mix of investments to get clients to their goals. Advisors now have the time and space to explore what really matters to their clients, and of course that is their dreams and nightmares. Financial service providers have a big role to play here too. By supporting financial advisors with in-the-moment insights and feedback about the effect of their behavior, the financial advisor can provide more just-in-time financial education. When clients are about to perform an action that could cost them in the long term or incur the behavior tax, or a lower investment return rooted in cognitive or emotional bias. Added to this would be systematically assessing the impact of the client's attitudes and personality on their dreams and nightmares without creating noise or random variations in advice that are not coming from change in client circumstances. In fact, personality science could be reshaping the scientific method itself. In a paper published in the Harvard Business Review in 2018, the authors argue that using machine learning to identify so-called high-risk customers, or those at risk of leaving the business, may be ineffective because firms are offering the wrong incentives to change that behavior. In other words, identifying a customer as high risk for a certain behavior, and switching could be one of these, could be ineffective if we design an intervention assuming everyone will respond to that intervention in the same way. With personality science, we can certainly understand more about the people behind the behavior. The implications of this paper are quite significant in that the scientific method of the future could have multiple interventions designed to be more effective to the target groups they are aimed at. So we could try and change switching behavior using different interventions, depending on whether someone is anxious or displays an inclination to focus on the present over the future, for example. This makes so much sense and sharpens our judgment significantly in respect of what works and what doesn't. If we think about it, previous interventions that were deemed unsuccessful may just have been unsuccessful on average, without more detailed information of the population. So interesting times ahead, indeed. But the question is, how will psychology slot into financial advice? According to the CFP board in the United States, financial decisions are rarely made based on logic alone. According to a Capital One survey, more than 75% of Americans reported feeling anxious about their financial situation in January of 2020. Consumers' financial stress has only gotten worse due to subsequent record high levels of inflation, with nearly 90% of Americans citing this as a top financial planning concern. As is clear globally, people tend to make mistakes when they're under stress, and particularly when they feel in danger of losing money. In South Africa, since the COVID period, the behavior tax has remained alarmingly high. Approximately 3.5% of clients' annual returns on average are being sacrificed from trying to time markets. These are the highest levels ever experienced since momentum investments have started to track this metric. In line with psychology making its way into the CFP syllabus, advisors need the tools to systematically diagnose and guide clients with different attitudes to money, personality traits, and risk behavior history to try and avoid this behavior tax, despite these inherent characteristics. AI most definitely has a role to play here too. As it stands, the best way to diagnose someone's personality, for example, is through a questionnaire. In other words, to ask them about their attitudes towards money, or whether they think about the future consequences of their actions, such as saving or indeed not saving. This year, Momentum Investments, in partnership with our channels, will test what we call a money fingerprint that helps advisors diagnose and predict their clients' risk behavior, day-to-day money management behavior, and links to their personality. I've personally witnessed now early trials in coaching programs that couples with very different money fingerprints are quite likely to experience conflict. For example, an introverted and structured organizer very focused on the future who worries about money will likely butt heads with an extroverted impulsive spender who doesn't worry about money at all. What makes this trickier is where there is an imbalance in earnings. The dominant couple behavior will likely mirror the breadwinner's preferences that can isolate the remaining partner, who may then act out in manners that are completely unrelated to money. For example, withholding affection, time, or being present in the relationship. The reality is that more than 1 in 5 divorces are because of these money conflicts, as cited by the US CFP board. In the future, we could very well see AI being successful in predicting a client's personality and money attitudes from their social media footprint or even smartphone sensors. Studies are already surfacing predicting the level of extroversion from smartphone location data that reveals where people are on a Friday night, for example. At home watching Netflix, which may be linked to introversion, or out and about linked to extroversion. Music preferences, The diversity of your iTunes playlist, for example, may predict your level of broad-mindedness or curiosity, which can be supported by Facebook likes, for example. As the open banking trend moves to South Africa and transactional spending data becomes more and more available, this could also support prediction algorithms even more. Regardless of the efficacy of AI in this arena, personality diagnosis and the application thereof in financial planning is likely to increase. Later this year, in partnership with a number of Momentum business units, we'll be exploring using machine learning to predict longevity in retirement to help our advisors give behaviorally informed advice. Should advisors recommend a life annuity or a living annuity or both? This is not an easy decision to make, and machine learning can most definitely make the choice far simpler for advisors when linked to health data, like medical claims, for example, or behavioral data, like how active the person is. Another example of using computational efficiency to allow advisors to focus on dreams and nightmares. But how have we been using machine learning to date? Unsupervised machine learning or clustering helps us to understand the structure of behavior patterns over time, and indeed if these were changing or not. While everyone tends to have stable attitudes towards risk over the long term, we like it or we don't, the reality is that how risk feels to each of us in any given moment is likely to be far more volatile. This has been shown to be the case in a number of experiments where investors who experience consistent negative outcomes tend to feel more risk or heightened risk levels, while those that experience consistent positive outcomes tend to feel reduced levels of risk. Both groups usually adjust their investment behavior accordingly. These patterns or clusters of behavior came through rather strongly since the onset of the pandemic in 2020. When looking at each and every switch decision made by investors on the Momentum Wealth Unitrust platform since 2020, 4 clear behavior patterns become evident, each with varying consequences for the investor. The most value is consistently destroyed by the market timer cluster. These investors are the most active, executing the greatest number of investment decisions. In other words, they switch the most. They chase higher past investment performance and also lower past investment performance. In the latter case, this is usually reflected by moving to the cash side of the risk spectrum. The second highest behavior tax is incurred consistently by the assertive investor. In 2022, they incurred the greatest behavior tax of 4.5% of investment returns when no other archetype incurred a behavior tax for that year. As the name implies, the assertive investor chases past investment performance consistently. This behavior is usually associated with up-risking of the portfolio. Third, we have the loss-averse, anxious investor. This archetype doesn't mind taking investment risk, but is very sensitive to paper losses. At the first sign of these, they tend to shift their investments towards historically lower performing investments, like cash. This is usually associated, once again, with de-risking the portfolio as well. Finally, we have the risk-averse avoider archetype. These investors tend to invest the most conservatively and then get stuck there. They switch the least and move money in between the same risk category investments when they do switch. They are likely the yield chasers seeking more security. We also need to remember that these investors may pay another form of behavior tax, being an opportunity cost of investing too conservatively, perhaps over a lengthy period of time. While unsupervised machine learning algorithms are a great way to show the structure of behavior or preferences over a period of time, supervised machine learning like artificial neural networks or random forests that use a decision tree kind of architecture are a great way to help us predict behavior. In a recent paper published by Momentum Investments, we showed around 9 different features that are strong predictors of investor switching behavior. These 9 features relate strongly to risk behavior literature and clearly show that how we behave when we make investment decisions is a function of how risk feels to us or how we perceive risk in the short term, as well as our belief system about the way the world of investing works. A feature of using supervised machine learning, like the random forest for example, is that we can extract exactly how much of an impact each of these factors have when the investor considers making a switch decision. The top line of factors related to the investor's age, the number of funds in the portfolio, and the portfolio value. When using a technique called Sharpe values, it becomes clear that portfolio value doesn't have much impact until the portfolio value exceeds 300,000 Rand. Then it has a big impact on predicting the switch. Age also doesn't have a uniform impact. Investors become more likely to switch over the age of 50 and then become less likely to switch over the age of 80. When it comes to the number of funds in the portfolio, As this exceeds 10, the likelihood of switching increases sharply once more. All three of these factors support the fact that approximately 75% of the behavior tax occurs in living annuities, or people who are in retirement already. This also confirms that people in retirement are particularly sensitive to changing portfolio values. Next, we see the investor's belief system is also important. Using SHAP values again, we saw that if the investor has only switched once before, this has little predictive power. But if they've switched 2 times or more, the likelihood increases sharply that they'll switch again, particularly as the size of the switch transaction increases over 100,000 Rand. This is also linked again to the portfolio value. Finally, risk perception also relates to the investor's 6-month and 12-month investment performance or outcomes. Here it's a bit more difficult to tell exactly where the sweet spot is, but given the importance of the 6-month and 12-month performance, and given that these intervals are usually linked to review periods with advisors, it seems that financial advisors are definitely linked to the behavior. And this is where these types of information regularly surface. When combining the two techniques, the results are both interesting and encouraging. When tagging each investor with the cluster labels we mentioned earlier, and then apply these to the predictive model to analyze any differences in switch predictions, the random forest algorithm places the market timer archetype as the one that consistently has the higher prediction to switch. Approximately twice as likely when compared to the anxious archetypes, and 3 to 4 times as likely as the assertive and avoider archetypes respectively. This was over a relatively short period studied. Also note the 2 dotted line boxes for the anxious investor, where the switch prediction rises during periods of high market volatility in these 2 periods in 2021. These investors are anxious. The market timer prediction similarly spikes in the white box with a sharp market recovery early in 2022. The predictive algorithm is confirming what we know about the investor groupings. In other words, that investors are not homogeneous in their predictive behavior. Some groups are more or less likely to engage in the behavior at different periods of time. The group with a consistently greater switch prediction value is called the market timer for exactly this reason. Finally, we can evaluate overall effectiveness of the predictive model by examining how much lift the model gives. In other words, how much more likely it is to give a correct switch prediction when compared to a random coin toss model. Lift curves demonstrate how well the model ranks investors by their likelihood to switch for different percentile model scores. On your screens are the results for the different data segments used in building the model. The 20 million observations from over 90,000 clients are split into what is called training data for the algorithm to learn relationships between the features we discussed and the behavior, which of course is switching. We then expose the model to new data it hasn't seen before to explore how effective it is in predicting the behavior. Here we see the data the model is trained on is almost 10 times better than a random model at predicting switch behavior. This is the red line. To the 2 new time periods of data, however, the model is approximately 7 and 8 times as effective as a random model, respectively. We would expect these slightly lower results for the new data, as the model will always misidentify noise as valid signal in the training process. These results show the model is very effective, however, in prediction and provides an excellent application of machine learning to the value proposition of the behaviorally informed advisor. Once the AI has generated behavioral insights and predictions, the next step is to conduct experiments to see which approach would be best in shifting the behavior to the benefit of the investor. Earlier we talked about where psychology and personality science fits. We need to know more than just a prediction from an algorithm. Just because we can predict something doesn't mean we can necessarily change it. We also need to understand how likely that person is to respond to our intervention. This is where personality science can play such an important role. If we know that the switcher has a particular personality trait, for example, neuroticism or high levels of anxiety, we could position the intervention as reinforcing the safety of staying invested in the long term. Literature has also supported the fact that a safety message appeals to people with this trait. This is the key message here. The more we know about the person we're aiming the intervention at, the more likely we can change that behavior of the people the algorithm is giving a strong prediction for. More literature and evidence is also emerging of intervention failures, backfiring, and even unintended consequences. We can't simply assume that warning investors of something will have a positive effect. Machine learning is great at learning patterns in large datasets, but it also learns noise. We can't guarantee that we only contact investors that are going to incur a behavior tax when making a switch decision, or that by contacting investors about switching, we actually don't inadvertently cause that switch. This is where the field of behavioral science has a larger role to play in the scientific process and ensures that overall we are making a positive change to investment behavior. While there are many suggested approaches and frameworks in behavioral science, we use the basic framework used by the OECD and taught by the iNudgeU Institute in Denmark. This basically summarizes behavioral problems into one or more of four following root causes. Firstly, there are attention problems. Are investors shifting money around between unit trusts because they have a focus problem? Said differently, is their attention in the wrong place or being drawn to the wrong place at the wrong time? Where do investors get performance information from? Is it from an MDD or fund fact sheet, or perhaps from a report the advisor is giving to the client? Is there too much clutter around the information that matters to clients? Said differently, can clients answer the simple question, am I okay, from all the information overload that they receive? If not, this could be part of the problem. Secondly, there are belief formation problems. We've already seen that the win, stay, lose, move belief system is very much alive and well with investors. How do we change this? Certainly a big influence here is the financial advisor. How can we change the financial advisor's belief system? A recognized technique uses support judgment, for example. We are social creatures and tend to behave as others behave, and also look for confidence in behavior of other people or people that we respect. How do we change the win, stay, lose, switch belief system? How do we reinforce the right behavior? Thirdly, there are choice problems. Can we perhaps frame switching as something negative, perhaps like a switch itch? Can we also trigger more of a sense of community, perhaps, by alerting investors to those who are not switching? Finally, there are determination problems. These are, in essence, willpower problems. How do we get investors to commit, even socially, to staying invested? We sometimes do different things when people are watching, particularly those we respect. Can we provide real-time insights and feedback into the cost of switching to other investors, such as the behavior tax? Will this have an impact in reducing the behavior, and by how much? These are important questions, some of which we don't as yet have answers for. But behavioral science is not about having all the answers. It's about being inquisitive, failing often and fast, and moving on to the next question. The challenge for financial services providers is to create the environment and technology to conduct these multiple experiments and help us in acquiring a new mindset that return on failure is also valuable. It's not just about return on investment. There is never one correct recipe or intervention, and decision context is highly variable. This is where the science in behavioral science comes in. Experimenting and figure out what works and what doesn't. This area is going to be a big focus area for us as a business in the near future. The behaviorally informed financial advisor sets the scene for the future of financial advice, where speaking about better returns and picking better funds is replaced by better connection and better decision making. You've all probably seen the internet meme where author and video game enthusiast Joanna Maciuska says, I want AI to do my laundry and dishes so that I can do art and writing, not for AI to do art and writing so that I can do more laundry and dishes. While we've been talking about AI as an enabler of better decision making, this is likely to empower financial advisors as the ultimate interpreter of the client's unique decision context. So the advisor with better knowledge of their clients decides on whether to pass on the nudge or not. Again, the advisor remains an important cog supported by AI and not replaced by AI. This also means that true connection replaces tone-deaf financial education. In a well-cited example, a financial advisor is sitting down with a prospective client who has just received a tax rebate. The client informs the advisor of her intention to buy a big flat-screen TV with the proceeds, and naturally the advisor continues to object to this decision, citing wonders of compound interest over time and the client's dire retirement forecast. As it turns out, though, in this specific case, however, the client is living in a rough neighborhood and is buying the TV so her two kids stay at home at night, where, of course, it's more safe. This is an example of where the right answer is wrong. We should never assume to know better than people we are advising. After all, we are all experts in our own lives. Financial psychologists Brad and Ted Klontz give evidence in their book titled Money Mammoth that behaviorally informed financial advice uses principles in financial psychology is more than 3 times as effective as using financial education alone in changing that behavior. Bombarding people with information, even though correct, can be ineffective. A financial advisor who spends more time listening becomes very tuned into that client's unique circumstance and has more valuable insights to offer, which behavioral interventions are needed in order to change that behavior. When these contextual insights are combined with machine learning insights and personality science, the advisor uses technology and hyper-personalized client engagement that is applicable to that client's unique circumstances. In other words, the advisor remains the ultimate decision maker in guiding which content is delivered to which client and when. This could be a personalized podcast on the importance of staying invested, but providing actual feedback on the effects of past investment decisions and the impact this has had on that specific client's wealth. or perhaps how inflation works, but in the context of that client's cash balance over time, so the effect of their risk-avoiding behavior on their portfolio over that period of time. These insights, when paired with techniques in financial psychology to track and measure behavioral change, is where financial advice is headed. Thank you so much for your time.
Thanks, Paul. Steve Martin, the Chief Executive Officer at Influence at Work, will explain what the influence equation is. He highlights the importance of evidence, economics, emotions, and context when deciding how influential information can or cannot be. He also highlights how different people or teams can have different influencing styles. Are you a data aficionado, a calculating connoisseur, or an empathetic orator? Let's find out. Over to you, Steve.
Well, thank you very much indeed for that kind introduction, Evan. My name is Steve Martin, and it's a pleasure to join you on this Momentum Investments Group Behavioural Finance webinar. I'd like to talk today about the psychology of influence and persuasion, but I wanted to start out by first talking about LinkedIn. Now, LinkedIn is going to be a social media platform that I'm sure is familiar to all of you. I'm sure every one of you is a member and probably engages, posts, and uses the platform to do all manner of things, including connecting with your network, looking for new opportunities, and maybe occasionally sharing the interesting, strange stories of the activities and behaviors that a number of your work colleagues get up to. I like LinkedIn a lot. I don't like LinkedIn just from an observer's perspective. I actually enjoy LinkedIn from a researcher's perspective as well. One of the things that LinkedIn does is it creates and delivers lots of surveys. One in particular caught my attention a few years ago. It asks a single question. What is the most important skill that is required in your workplace today? This is a question that has been asked for 17 years now, each and every year. And as you can imagine, over those 17 years, the ebbs and flows of business, the way in which technology has evolved, the different skills that we require in our organization has changed considerably over those close to 2 decades. Yet there's one skill that never, ever fails to feature in the top 3 requirements in any organization, requirements regardless of the type of company or organization it is. And that skill is influence. The ability to connect with others, engage with the unengaged, convince people to act. That seems to be a skill that is universal, a skill that is important and in requirement regardless of where, when, or where in the world you actually work. Now, there's been lots of books written about the psychology of influence. There's lots of research that's actually been done. But the thing that I think we can all agree on when it comes to the psychology of influencing and persuading others is that it's incredibly complex. It's very context dependent. It's socially intertwined. It's just messy. And just close to a couple of years ago, I was contacted by The Economist, the global newspaper group, and was invited to essentially write a guide to how influence works that in a way kind of puts some order around a very complex, socially intertwined and messy subject. And the purpose of me speaking with you today is to kind of share with you for the first time what I've come up with, what that order looks like, and in the pursuit of doing so, hope that I can provide some useful insights, some usable tools, some tactics, some hacks that each of you can use to increase the likelihood that when you deliver a message or seek to present a proposal, people are more likely to listen, pay attention to what you have to say, and ideally say yes to that. My starting point for this work was to actually consider the primary colours. As those of you that will remember from art classes back in high school, the adage here is that we can take one of 3 primary colours, blue, yellow, red, and mix them in various quantities and make myriad other colours. In fact, 3 primary colours are at the central source of every colour. And I kind of liked this idea because I think it speaks nicely, certainly metaphorically, to this idea of influence. What are the key components of successful influence and communication that are always there, that are always available for us to use, that we can use to construct effective communication strategies, influence and persuasion appeals? And so, inspired by that primary colour metaphor or analogy, what I'd like to talk to you today about is what I'm describing as the influence equation. I'm going to make this bold claim that there is a formula, a framework, an equation to successful influence. And it looks like this. Successful influence and your ability to connect and engage with others is a function of you being able to present or highlight the right amount of evidence, the appropriate economic appeal, and the appropriate apportionment of emotion. Those three things are always present in every successful influence negotiation, but never in equal measure. It's not that if 33% of your approach is evidence, 33% is economics, 33% is emotion, then that's the answer. No, it's not that at all. In some instances, it will always be about the evidence, and economics and emotions pay a backseat. But in other instances, it's all about the emotions or the economics. The key differentiator is the context in which you're sitting in. So the relative proportion of evidence, economics, and emotions that you use in any influential appeal or communication will depend on context. Put another way, successful influence and persuasion is all about the right combination of facts, finances, and feelings. Let me give you a practical example of what I'm talking about here. Let's consider the job interview. The job interview, I think, is a really good example of influence at work, because the person that's applying for the job will want to kind of persuade that company, that recruiter, that they are the best candidate for the job. The recruiter, of course, will want to persuade willing and available candidates that their organization is a good one to come and work for. And subsequently, all three elements of our influence equation are available: the evidence, the economics, and the emotions. Let's talk about briefly the evidence. The company that's concerned, that's recruiting these candidates, will want convincing evidence that that candidate is the right person for the job. They have the skills, they have the competence to be able to do the job. And equally, the candidate themselves is going to want to seek evidence that the company is going to be a good one to work for. It's going to be one that's going to provide them with personal development, their growth plans, a good career move. The economics are important too, of course. The candidate is going to want, ideally, to be paid as much as possible. But it's not just about the money. There's going to be other economic considerations like training, like career development. They're going to price that into their thinking. Equally, the recruiter is going to have economics on their mind as well. They're going to want to pay a decent salary, of course, but they don't want to pay over the odds. Ideally, they want the best possible candidate for the lowest amount of money. And then finally, emotion plays a role. We've all been in that situation where we've been interviewed, or we are the interviewer, and you just get a good feeling about something. You know, the recruiter feels this is just the right candidate for us. It feels right. And equally, as perhaps the interviewee, we might be interviewed and think this is just a really good place. I get a good feeling about this. So there are our three components of our influence equation, all at play on both sides of, in this case, the interview. Now, here's the important thing. Context throws that equation up in the air a little bit, okay? Because think about it. If there is an abundance of available candidates, then suddenly the equation becomes a different set of weighting. The recruiters arguably could command more evidence from their candidates about who is the best. They may not necessarily have to weigh so much on the economics. They may need to pay a slightly less price for the best candidates. And perhaps time will be on their side. They can interview more candidates and wait for the right emotionally fit candidate to come along. Of course, if the context changes and there's a scarcity of candidates, then suddenly everything is weighted in the favor of the person seeking the job. Perhaps they don't have to apply as much evidence to their supporting their application. Perhaps they can command a better price. Perhaps they can wait for the emotionally fit environment and workplace they want to work in. So essentially, I think what the workplace interview, the job description and the job interview actually does is it provides a really neat example of the influence equation at play, that there's always going to be some element of evidence, economics and emotions, but of course the context is actually going to matter a lot. So there's the theory. Let's talk now about the practice. How do we actually put this together? So I'm going to talk about each of these specific nominators for the equation in turn, give you some examples of what's important. Let's start with evidence. Now, it turns out that evidence by itself doesn't influence. Okay? Evidence alone is not a mechanism for influence, for communicating with people, for persuading them to change. Other things matter. Specifically, what we compare our evidence to is the source of influence. Who we choose to deliver evidence is the real lever of influence and persuasion. And importantly, how much evidence we provide has a big factor on how successful we will be at landing our message. Let me give an example of each of these. Take a look at this data here, this evidence, and it clearly shows us that the office cleaners in our building, their salaries are falling behind. As you can see here, they've been falling behind for close to a decade now. No surprise, of course, that the cleaners unions are starting to get angsty about this and demanding from managers that their salaries are increased. But to my point earlier, it's never about the evidence by itself. It's always about what we compare the evidence to. For example, if we were to present this same data on a logarithmic scale, you can actually find that, yeah, the cleaners' salaries are behind the managers, but they're actually catching up. That gap is actually narrowing. In fact, if I present the data as an index, the data actually shows the opposite. Okay, it's actually the managers that are falling behind. And if I do that year to year, I can now present data that shows that the managers' salaries are actually decreasing. And it's not the cleaners' salaries that we should be increasing, it's actually the managers. Now, this is one single example that illustrates a universal point. It's never the evidence itself that influences your outcome. It's what you compare your evidence to. And so the implication of that immediately is when you are seeking to influence, engage, persuade others with a piece of evidence or a piece of data, don't just think about what am I going to say. The first question you want to be asking yourself is, what am I going to compare this evidence to, ensuring that it actually then is presented in the best possible light. But it's not just about what we compare the evidence to that matters. What also matters is who delivers that evidence. We did a study here at Influence at Work a few years ago with estate agents in London, and we found something interesting. We found that the likelihood of someone that's interested in selling their house or leasing their property, choosing a particular real estate agent, was not so much on the characteristics or the evidence that the estate agent could provide about how good an office or an agency they were, but rather how their agents were introduced. When someone came in interested in selling their property, when we arranged for the receptionists to genuinely introduce their agents as legitimate experts, the likelihood that people would actually appoint that agent and get them to come value a property and then sign a contract with them rose significantly. Now, we all know about this because oftentimes we've been in situations where we've gone into a presentation, a meeting, we've delivered a message and it's fallen on deaf ears. Yet a couple of days later, someone else comes along with the exact same message, and now that message is seen as the best thing since sliced bread. Notice something. The message never changes. It's the messenger. So, who are the messengers in our society, in our businesses, in our organizations that are most likely to be the ones that are listened to? Well, think about these three things. How do you convey your competence? How do you convey that you're trustworthy? And ideally, how do you convey to the person or the group that you're seeking to influence that you are like me? And actually, those of you working in behavioral finance and that have experience in this field will, I'm sure, be very, very familiar with decades now of research that actually shows that when people are selecting a financial advisor, an investment manager, a financial planner, they're significantly more likely to choose the person that seems trustworthy and is like them than necessarily the person that has all the evidence about the creds, the competencies, the exams that they've actually taken. One last thing about evidence. How much should we present to people in order to optimize our appeal? There's a very clear answer to this from studies led by Susan Shu over at South California University. Let me give you an example of just one of those. In these studies, what the researchers do is they present a series of propositions in the form of products, proposals, and in sometimes people to a variety of individuals. And each of those products, those people, those propositions are supported by a number of claims, a number of points of evidence, sometimes 1, sometimes 2, 3, 4, 5, up to 6. Buy this shampoo, here are 6 reasons why. Vote for this politician, here are 3 reasons why. Buy this car, here's the single reason why. What the researchers are looking to do is understand how much more convincing does each point of evidence become. And here are their data. And as you can see, there seems to be a sweet spot. And the sweet spot is 3. Not only do people's reported attitude towards that product, that proposition, that person rise, and actually that's the pinnacle of the influence at 3. Notice how their skepticism and their reported cynicism of what's being said also rises. So, a couple of implications for you in terms of who delivers the message and how much. The first is to remember, you might be the expert in the room. You might be the most knowledgeable person, the best place, at least evidentially, to present the case. But that doesn't necessarily make you the right person to deliver and present that evidence. Sometimes the messenger and the careful selection of the messenger becomes more important than the evidence that supports the message. And secondly, when it comes to presenting this evidence of yours, the rule here is that 3 charms, but 4 becomes an alarm. So that's the first nominator of our influence equation. The second is economics. Clearly, if we want people to do something, one way to do it is to pay them. Okay, let's just incentivize them, provide extra money, incentives, bonuses, these kind of things. But as those of you that have worked in the behavioral finance and the behavioral sciences categories more broadly will know that whilst people do respond to incentives because they're quick, they're easily understood, everyone loves them, their reaction to them is largely shaped by psychological mechanisms. And there are 3 here that are especially important: frequency and timing, ownership, and scarcity and loss. I'll give you a couple of examples from studies that, again, my team and I have been conducting over the years. So here's a question. How do we persuade bus drivers to do so safely? Well, one way is to pay them. In fact, this is data from a set of research that my colleagues and I did a few years ago in New York. One of the things that we know is that buses are much less likely to be involved in a heavy braking incident or an accident if the distance between the front of the bus and the car or vehicle traveling in front is 2 seconds or more. And so what the Transport Authority did in this instance was come up with an incentive that encourages drivers to leave that minimum of 2 seconds between the front of their cars, their cabs rather, and the cars or vehicles in front. The best way to do that is to pay them. But what's really interesting and what we found in these studies was it wasn't the amount of money that they were given that caused them to comply, but rather the frequency of when that money was given. Compared to paying them $100 a month for safe driving, bus drivers were much, much more likely to comply with that safety recommendation if they were paid $25 a week. Same amount of money, but frequency and timing changed. So when it comes to the use of economics and incentives in our influence equation, don't just think about what the incentive is. Think about how it's framed in terms of its frequency and its timing, because they matter. So, the scarcity and ownership. Here's a question for you. How do you measure the popularity of a royal wedding? As you probably recognise from my accent, I'm a Brit. We have our fair share of royal weddings. There's a number of ways in which we can measure the popularity of these events and these ceremonies. One is we can look at the number of people that line the streets of the Mall and Buckingham Palace in the hours and days leading up to the ceremonies. We could also look online, and we could look at situations where people are looking at online videos of or television audiences. We can measure all these things as well. Another thing we can do is we can measure the sales of royal memorabilia. In fact, by that particular measure, the marriage of Charles and Camilla, however long ago it was arguably the least popular wedding of recent history, because sales of commemorative tea towels and mugs and all sorts of different royal emblazoned souvenirs were very slow, both in Windsor and in the London souvenir stores. But interestingly, about a week before the wedding, that changed. All of a sudden, the sales of these wedding souvenirs and memorabilia skyrocketed. So the question is, why was that? Maybe it's just that people leave their souvenir buying until the last minute now. We live in a very present tense organisation and kind of world, but actually that's not the case. The real reason why the sales of these memorabilia for the royal wedding rose was because the Pope died. Yeah, that's right. At the beginning of the week that was scheduled to have the wedding of Charles and Camilla, Pope John Paul II died. And in a mark of respect, and to allow Charles to actually attend the funeral of the Pope, Charles and Camilla and the royal household shifted the day of the wedding from the Friday to the Saturday. And now every souvenir in London and Windsor has the wrong date on it. People recognizing this scarce opportunity to almost buy the modern equivalent of the misspelt penny black suddenly converged on all these stores. And what was really interesting was I read reports of reporters who were interviewing these people saying, are you a royal souvenir collector? No, absolutely not. I'm just seeing an opportunity here. I'm seeing a scarcity. And what's important is once they've actually been influenced by that scarcity, they now have something that they own. And what's really interesting about ownership is our value of something goes up significantly. Best example I know is if you're feeling in a mischievous mode or point of view, go down to some corner shop one day and look out for someone buying a lottery ticket. Go up to them after they've bought it and try and buy it from them. I tell you now, $1, £1, a $2 lottery ticket that they just purchased doesn't change objectively in terms of its economic value. But people want a hell of a lot more money for it now because it's simply not a piece of paper anymore. The chances of them winning, for some reason, have gone up in their minds. They have an ownership of it. And that leads us to the third important point, and one that I'm sure many of you are going to be familiar with when it comes to using economics to influence and persuade others. And it's this idea that once someone has ownership of something, their desire to keep hold of it and their essentially reactance to potentially losing it goes up exponentially. We know, for example, from PGA tours, that the player that is actually leading the pack after the first round, particularly if it's a marginal lead of 1 or 2 strokes, invariably never wins because the game has changed. They're not playing to win anymore. Now they are in the lead, they're playing not to lose. And just to bring it back full circle to our bus drivers in New York, that's something that we actually found when we did these studies. We found that by paying them, if you remember, $25 a week rather than a bonus of $100 a month, there was an increase of 23% to the compliance of that safe following distance. But here's the problem. After 4 months, the effect regressed back to the mean. So it had an immediate impact, but after 12 to 16 weeks, it basically went back to how it was before. So we entered into another series of tests. And in this instance, we introduced not just that frequency and timing difference, we also introduced a loss to it as well. And the way we did that was by paying the bus drivers in advance. So instead of saying if you drive safely at the end of the month, you'll get $100 or $25 in the case of a week, we instead said, here is the money up front in anticipation you will complete this. And you just pay back what you don't legitimately earn. And in that instance, the effect actually was maintained. Last thing in our equation then, emotions. So we talked about how evidence is an important denominator, or nominator rather, of the influence equation. Economics is an important nominator, but so too are emotions. Take a look at these two ads. Both of them are advertising to visit the city of Las Vegas. One appeal, though, takes a particular route by suggesting that visiting Vegas is a unique experience, do something differently. Whereas the other ad is pointing people's attention towards the popularity of Vegas. Come because of more and more people visited more than any other city. The question, of course, we want to ask here is, which of these two ads is the more influential? Which of these two ads is more likely to compel people to want to find out more information, seek more advice about going to Vegas, maybe even search on an internet engine for a flight, a hotel, these kind of things? The answer really is that both of these ads are effective, but the emotional mood of the audience has a significant impact on which one of these will be the most persuasive in a particular context. How do we know this? Well, we know this because these studies, conducted by our powerful ad over at the University of Minnesota, were conducted in cinemas. And these ads were shown during and immediately after people were watching a movie. And the movie that they were watching was the thing that influenced their likelihood to be more persuaded by a scarcity appeal or a social proof appeal. If they were watching a romantic comedy, they were much, much more likely to be persuaded because their emotional mindset was one of intimacy, one of just you and me, private. I don't want to know what else is going on. But those people watching The Shining, the horror movie, they were much, much more motivated to respond to this appeal when the message was about social proof, because in that emotional state of fear and heightened arousal, they were much, much more likely to want to join others, the kind of safety in numbers aspect. Now, this is one really, I think, neat example of a much more universal point that I'd like to make here. And it's to notice that when people face hard questions, when all of us face hard questions, one of the ways we deal with that is to answer an easier one that wasn't asked. We don't know what the best school to send our kids to, who might be the next best prime minister or president. These are very hard questions to answer. We can't predict the future. So instead, we ask ourselves an easier one. How do I feel about this? And in that context, feelings are data. Feelings propel us to pay attention more to one thing than another. So what are the things that as influencers, as communicators, we should be aware of when we're seeking to use this nominator of emotion when influencing, persuading individuals and others? There are three. The first is we need to be clear about what I call mood monitoring and mood making. Secondly, our message should be designed to fit the emotion that that particular individual or group is currently in the moment we deliver that message. And thirdly, there are vehicles of emotion, ways in which we can convey and compel people to be ready to listen to our message. So the mood monitoring and the mood making is pretty straightforward. Okay. When it comes to mood monitoring, sometimes our ability to influence and persuade others is a function of good timing. If we're about to ask for some more budget and the financial director's just come back from a nice boozy lunch and the last quarter's profits are looking pretty good, then maybe we have got them in the right mood and our appeal will land favorably. But the other thing we can do is we can actually make emotional moments. as we did and as Vlad did with the experiments with the cinemas in Las Vegas, by essentially priming people to feel either intimate or aroused in terms of fear, they reacted differently. And so one of the things we can do as influencers is to recognize that before we deliver our message, before we make our appeal, it might be a good idea to think about the types of emotions that we might want to kind of install in people before we deliver them. What type of emotions? Well, it's here that I think that are very, very neat and very, very familiar to those of you who are psychology buffs model comes into play. James Russell's circumplex model, which essentially on two axes says that different emotions are essentially caused by how pleasant or unpleasant we are experiencing a particular situation at that moment in time, and how calm or how aroused or excited we are as a result. And here's a simplified version of that circumplex model. And as you can see, it, as a result, generates a range of different common emotional responses, from awe to sadness, from fear to calm and to empathy. The question is, what does that emotional state mean for people's reactions to subsequent messages? Well, we have that data too, and here it is. When people are excited, they are feeling pleasant about something, they think much, much more quickly, and their orientation is much, much more towards gains. So if you're going to put your audience into that kind of emotional state, you want to get them to think fast, you want to get them to think about all the upsides of your proposition. But actually, if that kind of arousing experience happens to be an unpleasant one, they still will think fast, but they'll act to avoid losses. And in some instances where perhaps there's a calming, there's little to no arousal, and the experience is deeply unpleasant, those are the situations where people are much, much more likely to accept losses. So I think this circumplex model is a really interesting and kind of neat way of thinking about not just how we present our economics and our evidence, but also how we choose the right moment and the emotional fit for our message to land favorably. Last thing. How do we then deliver that message in that emotional context? I think there are two ways. We can do that through anecdotes, and we can do this through analogies. Anecdotes are simply stories. They're usually personal ones that compel or initiate an emotional connection. That's what the anecdote does. Whereas the analogy has a slightly different route to connection and communication. Stories, again, also could be personal, but what they do is they initiate a kind of cognitive connection. And so depending on whether the message you're delivering is going to be one where you want to kind of initiate that emotional connection, or you want to kind of explain something that's relatively complex in a simple way, that would guide you to determine which anecdote or analogy that you would actually use. Now, why are they and stories more important? Here's the reason. People will argue against your evidence. People will argue the stats. People will argue your data. But rarely do people argue with your story. Hence, the most effective communicators, the most persuasive messengers, always lead with the story and follow up with the stats and the evidence. Stories trump statistics. So there we have it. A couple of years ago, the economists came to me and they said, okay, influence, this is an incredibly complex, challenging, multifaceted, socially intertwined subject. How do we make some sort of sense of it? How do we order it? And my attempt to do that is by the publication of this influence equation, that successful influence is always a function of a proportion of evidence, economics, and emotions, never the same. And that proportion of each of those is going to be dependent on the context in which you are facing or the situation you're going to. Put another way, facts, finances, feelings. If you're going to create an influence strategy, what do the facts say? What do the finances say? What are the feelings? What's the context, which will give us a clue about which proportion of those things we should prioritize? And the way to do that is to figure out, well, What sort of influencer are you currently? Are you the kind of data aficionado? Are you the kind of individual or organization that doubles down on the evidence and perhaps is missing opportunities because you're not so focused on the economics or the emotions? Or are you more the calculating connoisseur? It's all about the evidence. Or perhaps you are that empathetic orator, the person that focuses on the emotion first and then allows their evidence and their economics to essentially be built on that platform. Well, if you want to know the answer to that question, I've got some good news for you. Here is a free test that you can take. You can take this test, there's the barcode for it, and it takes you about 10, 12 minutes, and it will give you and your teams a pretty good sense. It's not, the be all and end all. It's not going to tell you psychologically how your life is going to turn out, but it'll give you good indications of your kind of preferred style when it comes to using this influence equation of economics, evidence, and emotions to influence and persuade others. And if you'd like to know more, the actual book that The Economist commissioned from me comes out in the US on the 3rd of September. And the rest of the world in the UK. There's my contact details. If you'd like to stay in contact, follow me on LinkedIn. That would be great. But for now, thank you very much indeed for your attention. Let me hand back to the conference organisers, and I wish you a very pleasant rest of your day.
Thank you, Steve. Last but definitely not least, Mike Chen, the head of alternative alpha research at Robeco, will tell us about the revolutionary impact that machine learning is having in the world of investment management. Mike and his team are looking for ways in which the use of alternative data and machine learning models can help identify sources of alpha or outperformance in ways that is not possible currently. In his talk, he'll take us through some of the initiatives that he and his team have successfully embarked on to enhance Robeco's current quantitative equity investment process based on the use of machine learning models and their related insights. We actively collaborate with Mike and his team from a research perspective and have a great deal of respect for him and the work he's doing. We are very glad to have him here in our studios in South Africa today.
Thank you, Evan, for that lovely introduction. And thank you all for your time and attention to my presentation. My name is Mike. I work for Robeco, which is a Dutch-based asset manager, and we're proud partners of Momentum. Personally, I'm from Taiwan, and I live in Boston at the moment. But I'm at Robeco. My job is the head of alternative alpha research, which deals with advanced technologies and advanced techniques in quantitative investing. In this session, I will talk to you about how machine learning, natural language processing, and all these new fancy terms that you have heard is impacting and affecting quantitative investing. So let's start by setting the context and telling you about evolution of quant investing. Obviously, with the hype around ChatGPT, let's ask a GPT-like model, how are machines affecting quant investing? Let's start from here. So you ask GPT this question, and it will give you some answers, right? And you can read the answer and decide whether you believe it or not. I hope after the end of my talk, you will see the answer that GPT give you is either sensible or not sensible. So let's set the context, right? There's been 3 trends that's really been transforming human society over the last several decades. And they are data, algorithm, and computing power. First, data. The amount of data that's being generated is just staggering. According to this statistic that is shown here, every day there's 463 exabytes of data being produced. So you might ask, what's an exabyte? Exabyte is 10 to the power 18. So that literally is 1 followed by 18 zeros. So it's a staggering amount of data that's being generated on a daily basis by humans on this earth. And according to some study, the amount of human generated data now doubles every 2 years. So since the beginning of time until now, we generate a certain amount of data. Next 2 years, we're going to generate equivalent amount of data, and that's only going to continue going forward. Second thing is the dramatic increase in computing power. The chart I show here is a logarithmic graph. So that means that the scale on the y-axis is not linear. If you put this in a linear scale, this thing grows exponentially. So it just shows you how much the increase in computing power we are now have in our fingertip. If you have a smartwatch on your wrist like I have right here, right? you actually have more computing power on your wrist than what it took the Apollo astronauts to plot their rocket to the moon and back 60 years ago. So just absolutely staggering. And then finally, there are all these really, really powerful computing algorithms that's available, right? So, everybody's heard about AI, and the image you might have is Terminator or, some sort of, robot that behaving like human. Well, AI is really rather more limited than that at this point in time. Doesn't mean that people are not working towards that vision of AI. They are, but at this point in time, it's rather more limited. At this point in time, AI really falls into two main categories, and I have shown in this chart here. One is ML, called machine learning. That really deals with finding patterns of relationship in a lot of numerical data. And the other branch of AI that's very hot in recent years is called NLP, natural language processing. That deals with reading human text and lately human voice in getting meanings and interpretable sense from them. And you can see that there's a little bit of overlap in the middle between ML and NLP. And this is because the common tools used in ML and NLP in recent years have been the same. A technique called a neural network that you might have heard of. And in the very middle, LLM, large language model, that is the GPT algorithms that everybody is really crazy about in the recent years. So, in addition to the evolution of technology, right, the quantitative investment field has also been changing. So this is kind of how it has changed over the recent years. 50, 60 years ago, anything above a cash deposit return is called alpha, right? So if you just invest in general stock market, more likely than not, you will get what's called alpha because, in the US, for example, the stock market returns 10% on average for the last 100 years, right? Obviously, people figure out that, to get market level return is not so special. So in the 1960s onwards, with the advent of CAPM, the market premia, which is market level return, is now separated from alpha. So anything above market premia, that's still something very special investors are willing to pay for, right? Move the clock forward another 10, 20 years, you have what's now called factor alpha. So these are phenomena in the market that people have discovered, such as value, size, quality, momentum, etc. These factors do deliver long-term alpha, but they're relatively understood. So definition of alpha keeps on evolving. Now, rather than in addition to factor alpha, there's what's called uncorrelated alpha. So alpha that's uncorrelated from what you can get from factor. So this is kind of how the quantitative investment field has been evolving over the last 50 or 60 years. Now, I talked about three things that's really transforming human society, right? These three things have also transformed quantitative investment, and I will talk about them. Specifically, I will talk about data, machine learning, and natural language processing. Let's start with data. Here is a chart of the data landscape in 2012. You can see that it's already very complicated. There are many, many companies in here, right? Here's what that same landscape looks like 10 years later in 2022. You can barely make out any company in this chart. The point is not to hurt your eye, make you squint and see who's what, right? The point is to show you that this data space ecosystem has just really exploded. It's really, really complicated. It's really, really diverse. There's a lot of company in here. So the question is, as a quant practitioner, how are you supposed to find information in this ocean of data, right? After all, a lot of these data are pretty much noise, right? And finance in general is a very low signal to noise environment. So how are you supposed to find alpha in this noise? Well, the flood of data is really a curse and a blessing, right? The curse is that there's a lot of information in here, most of which are probably useless. Blessing in the sense that if you do have an idea, there might be an data that you can use to validate or to refute your idea. Here's an example. One idea might be that, well, institutional investors, typically their actions are very informative, right? So wouldn't it be cool if we can know which institutional investors are visiting which company to see that which companies are being paid attention to by investors? Well, in the Chinese market, in their regulatory reform 2 decades ago, they institute that all institutional investor visits must be disclosed. So using this information, which falls into this alternative data space, we can know which company in the Chinese A-share market have investor interest. With that, we can test to see if investor visits do indicate a company that will outperform or not in going forward. So this is an example of using this alternative data, this sea of alternative data for your benefit. Next, let's talk about machine learning. So what is machine learning? Machine learning is really a new paradigm to think about how do you structure input to output, right? In the traditional approach, the way it works is that humans have an idea how the input should be related to output. They program some algorithms, the algorithm reads the input, processes them, converts them into output. So it's really human driven, right? Under the new machine learning paradigm, what you do is you tell the machine, okay, we have this input and we have this output. Now you figure out the relationship between them. And the relationship that you figured out, maybe we can use as a program to use going forward. So rather than human being the driving seat, human are kind of setting up the problem and then take a back seat to the algorithm, letting the algorithm figure out the relationship. So that is what the machine learning paradigm is. The beauty of machine learning paradigm is that, first of all, it's data driven. It can process a huge amount of data. We just mentioned that there's an ocean of data coming at you, right? Well, this ocean of data is really suited for machine learning. It can detect high order dynamics. What do I mean by that is it can detect nonlinear, so polynomial or exponential dynamics. So if something grows polynomially, machine learning algorithm can detect that. It can even detect interaction effect. What do I mean by interaction effect? Interaction effect is when you have a variable A and variable B. When they're separate, they have their own behavior. But when they are combined, the behavior changes of the joint behavior. And that kind of interaction effect actually happens quite a lot in finance. Machine learning can detect that. That's a very powerful thing. Because humans are not really good at thinking non-linearly and thinking about interaction effects. So the fact that machine learning can detect these patterns are very useful. And again, it's also very flexible, right? So machine learning, if you structure it right, it can prevent look-ahead bias, which is one of the big curses of quantitative investing. As human investors, we all have biases. For example, it is very hard for me to unlearn the fact that during 2008, the global financial crisis, right? A lot of financial stock, really got hurt. But with machine learning algorithm, you can actually explicitly keep that information out when you set up the program, so to prevent look-ahead bias. So it's very powerful. And here's an example of an effect that we discovered during machine learning. You might have known this reversal effect, right? Which is if a stock has moved down a lot, it will likely go up quite a bit, in the next period. Or if it's gone up a lot, it will likely fall down a lot. It'll go down a lot in the next period. This reversal, and reversal is one of the most well-known effects to financial investors. But by throwing reversal into our machine learning algorithm, we detected additional dynamic on top of reversal. What we have found is that reversals tend not to happen if price movements are accompanied by high news volume. What do I mean by that is that if a stock has moved up a lot, but at the same time there's also a lot of reportings about that given company, right? It will very likely be the case that the stock stays elevated or do not revert as much. Similarly for stock that goes down. Obviously, if you think about it, right, it makes a lot of sense. If a stock goes up and there's a lot of news article being generated, it might mean that the stock movement is really driven by fundamental information, right? Something new that came out that reevaluates the stock price. On the other hand, when the stock is trading without a lot of accompanying news, it could be trading in an information vacuum caused by people who really wants to push up the price for one reason or another, right? And because the price is dislocated from the equilibrium price, it will likely come down. So this makes a lot of sense. And obviously, if you explain it like that, it's intuitive. But now imagine if you have thousands and thousands of variables. You want to find how they interact to each other. 1,000 by 1,000 is 1 million. It is impossible, well, it's very difficult at least, for humans to literally look at a million combination, right? So this is where machine learning can come in and help us detect these relationships that are somewhat difficult for humans to detect. Yeah, so here's this slide just to show you that, again, machine learning can uncover insights beyond simple linear models. It can spot interactions, and it allows quants like myself to detect relationships that are previously not captured or not known, thereby adding additional alpha on top of our existing model. Finally, I want to talk to you about natural language processing. So natural language processing, as mentioned earlier, deals with human text, not just written text, but actually spoken text. And in finance, obviously, it's a system comprised of humans. You have broker reports, you have news, you have company transcripts all the time, right? So it would be nice if we can process it somehow, and natural language processing allows us to do that. So how do you do natural language processing? Well, there are actually some few very basic steps. First of all, you got to clean your data. A lot of what we can do is really not limited by the algorithm. It's really limited by the availability of data itself, right? So as long as you can, the first order is you have to get the data, make sure they're clean. And then the next thing you do is you token, what's called tokenize the data. So you chop this data up into smaller fragments. The reason you want to do that is that so now these smaller pieces can be read by computer algorithms. So then convert them into mathematical objects that computers can manipulate. And then once you tokenize it, you can apply it to different applications. One application is sentiment, which some of you might or might not know. Actually, it's the first application in finance for natural language processing is to detect whether somebody, whatever they said, is it a happy thought or is it a upset thought, right? So you can read conference call transcript to see if the company's executives are bullish or they relatively bearish, right? Or you can, for example, another application is you can look at whether the company's employees are very positive about a given company or very negative about a given company. And we typically found that, as you would expect, companies that are positive about the company tends to do better over a long horizon, right? Not only do their stock do better, but you can look at other evidence. For example, companies with more positive employees tend to be more productive, as we have shown in this chart here. Obviously, this is something that company executives know about, right? So know the fact that the quants like us are actually looking at what they say. So they've been changing their behavior over time too. So this chart here shows you the average CEO sentiment on a 3-year rolling basis over the last 15, 16 years or so. You can see that they've been on a steady trend up, right? So company executives know people like us are looking at their transcript and only want to invest with companies that with positive CEOs, so their language are becoming more positive over time. Obviously, for us quants, that represents a problem. So that means we can continue to develop new techniques that are more difficult for companies to make it less transparent, right? So one example is to not just look at company executive or even employee comments, but look at what they write about, especially those very strong worded languages. Here's an example, right? In this example here, this is a Glassdoor review from 2018 that says, in this particular review, the employees said the company is very creative with finances. Now, that sounds really bad, right? Creative and finance are typically two words you don't really want to see next to each other, right? So we came up with a program to see, can we find employee reviews with these sort of next level unhappiness? For example, this company is breaking the law, or these people are frauds. That's not your usual gripe, right? That's the next level of accusation. And it turns out that companies with these kind of sentiments being expressed about them have 3 times higher likelihood of a blow up 12 to 24 months after this sentence has appeared. For this particular company, it turns out to be Wirecard, which all of you guys know that in 2019 had a big scandal and blew up. Another way to prevent people from hiding their true sentiment is look at not just what they write, but what they write down, but how they say they think, say it how they feel, right? It's one thing to say the right word. It's a little bit more difficult to actually pretend you're happy and act like it, right? And I'll play a clip for you as an example here. I don't know how many languages you speak. I don't speak that many, but a lot of times, even when I come across a language that I don't speak, I can sometimes tell whether it's a happy conversation or an unhappy conversation, right? So here's a clip that I want to show you, and I want you to tell me whether you think the mom here is happy or not.
Let's see mom's reaction on my haircut. Let's see what she says.
Ma perché?
Che cosa, no?
Non mi piace. Ma perché ti fai capire che c'hai capito? Perché non ti godi capito?
Perché non ti piacciono?
No. No. No, non mi piace.
So most of you would have guessed that the mom in that video is not impressed with the son's haircut, right? I don't speak Italian, but I actually confirmed with an Italian-speaking colleague of mine, and that is indeed the case. Mom is not impressed. Now, why did I show you that clip? Well, I want to illustrate a point. Basically, sometimes even if you don't understand the words being spoken, you know what they're talking about. In fact, there's a 738-55 rule of communication that says only 7% of communication is in the words that's being spoken. 38% is actually in how it's spoken. A full 55% are the body language, facial expressions, etc. So up to now, right, NLP has only been on textual analysis, analyzing what's being written down in text. So NLP has been focusing on only 7% of the communication. Now, wouldn't it be great if we can extend beyond the 7%, go analyze the rest of the 93% of the communication? Well, in my team last year, we did a pilot project that turned out to be a success, where we are able to convert audio signals from conference calls, again, this time down, not transcript, but actual literal audio clips, and convert them into machine-readable objects and conduct analysis on them. So now I'm going to play you 2 audio clips, and after which we're going to run a poll, and you will let us know in this poll which one do you think is more excited between the 2 executives, which I will play the clip for you now. Here's the first clip.
I would just say that certainly already having the right-of-way and the infrastructure in the areas, in a lot of our OVM area, we have a loop system, so we have one line that we can...
And here's the second clip.
All right, Ben, let me tackle it first. Look, we don't give guidance, so here's what I will tell you. I will tell you that there are more buyers in the marketplace for hit content than there ever been in the past. So the way we look at...
Now, take your time, think. If you could only choose between these 2 companies, based on what you heard from these 2 executives, not on their word, but on their tone only, who would you invest with? If you have chosen executive 2, or company 2, you would have been right. Company 2 shows more excitement because the way executives spoke, the speech is a bit more faster paced, right? In general, we found that faster pace, higher pitch tends to show more excitement and tends to mean that executive have some hidden information about how future company results are likely to be positive. For your information, company 2 was Paramount Global. It was during April 2016's earnings call. And that was when streaming platforms are really taking off. Paramount, obviously, CBS has a lot of streaming content, and their stock has done tremendously well for about a year after this clip. And the first company is an oil production company, and in the mid 2000s, from 2015 and the mid 2010s, the oil energy prices was in a pretty tough shape. So those are the 2 clips. Obviously, this is a very obvious example, right? But there are actually higher order information that's containing audio that we're able to extract that were previously impossible without using these techniques. So I'd like to basically conclude. Going back to the question that I asked beginning, is machines going to take it over? And according to this Copilot program, which is the Microsoft equivalent of ChatGPT, it says that machine will actually help you a lot, but at the end of the day, you still need human involvement. I hope from my speech today, you can see that yes, machine actually are able to help you a lot, able to answer questions or using techniques that were not possible before. But at the end of the day, it is still driven by fundamental human intuition, right? It is still the human mind and creativity and judgment that really makes that makes the ultimate investment call. But what machine does, though, is it extends our capabilities so much more.
Thank you, Mike, and thank you to all the speakers for their fantastic input. To close, I have a few comments to make on what I thought of the content presented here. Derek Notman captured it very well in his presentation, where he said, in the future, technology will enhance the human element and connection, not replace it. The future is today. I fully agree with this statement. We are living through a sea change in the financial services industry. It is no longer a question of whether machine learning-based models are going to be part of the decision-making in the financial services industry, but rather exactly how and where they'll be used. The advantages offered by machine learning-based insights and the opportunities identified by the speakers can and will improve decision-making across the industry. While we still have a lot to learn about where exactly they are going to have the most impact and how to best integrate the insights into the existing processes, they will contribute. Companies must be aware of this research going on in this space and be flexible in terms of working out how to best integrate it into the investment decision-making and investment advice processes. It is not just the insights about the decision maker that matter. It is also understanding how to effectively communicate or engage with clients that matters as companies try and leverage the relationship with them. I also believe strongly that while our future will include the use of machine learning models, we are not looking at a future where decision making will be solely done by or outsourced completely to machine learning based models. As discussed at length in these presentations, these models offer significant benefits by coming to a decision-making problem without the biases and cognition and emotions that decision makers have. But the problems that are faced in the world of finance are not the sort that will be able to be solved completely by using these models. There is still too much uncertainty, context-specific information, and sensitivity around communication, which these models can't accommodate, at least not right now. With time and further innovation, this perspective might change. But right now, machine-based decision-making should be seen as a significant support to existing processes, not a replacement for them. People still need people to work with and make decisions. In conclusion, the combination of machines and people is our future. And I'm really looking forward to the journey as we work out how exactly to create and deliver the benefits that machine learning-based models offer to decision-making in the world of finance. Thank you for your time and attention today. We hope you enjoyed this webinar.